All right, welcome everyone to the 2025 annual Spellman Fund Report. Appreciate you guys taking time out of a beautiful Friday afternoon to come listen to us present. I'm Elijah Ferguson, Maya, Joey, Noah, and Charlie. We make up the investment management team. What we do, we meet weekly or bi-weekly to discuss and track how the fund is doing, writing up monthly reports and mid-year annual reports. This semester, we've been meeting with the investment club as well, just to kind of broaden our outreach on campus and just grow the fund's knowledge. The outline for our presentation today, I will go over the overall portfolio return. The rest of the team will cover best and worst performers, sector weights and returns, sector revenue analysis, performance attributions, recommendations, and then talk on the rest of the class presentation. Right here, we have the overall portfolio return. As of April 21st, 2025, the fund is worth just over $450,000, with just over $432,000 in equity, about $18,500 being in cash. So as you can see here, the one-year return for the Spellman Fund was 2.15% compared to the S&P's 4.37. I'll show this graph here. The beta is up from 0.93 at the mid-year report, so closely mirroring the S&P, closely to our goal, which is what we want. A better explanation though on how the fund may have performed is a Sharpe ratio, which the Spellman Fund is at negative 1.63, means that we took on risk, but we're not rewarded as much with the risk. The test for this though is the standard deviation was actually lower than the S&P 500. So it's more based on how the stocks are picked and just making sure that our stocks are weighted correctly, as some of the lower performers were weighted more heavily than the higher performers, why they were able to bring the Spellman Fund back up. Next up, we'll have Maya talking on the best and worst performance.
Okay, so starting with our best performing stocks in the fund, we have Netflix, who is our highest performer this year with about a 78% return and a 1.1% contribution to return. Netflix is continuing to increase their international subscribers due to their new tiered pricing structures. In addition, they have been entering into the gaming and live streaming spaces like comedy events and sports events. And then next we have PayPal, who had about a 42% return and a 0.29% contribution to return. In February, PayPal launched their new PayPal Open platform, and this allows businesses to streamline their payments, access financial services, and risk solutions. Then lastly, we have SAP, who had about a 42% return and a 0.5% contribution to return. SAP is continuing to increase from their cloud-based solutions, and additionally, their new Rise with SAP initiative has been modernizing their clients' digital infrastructures. And moving on to our worst performers in the fund, we have Intel, who is our worst performer this year, with about a negative 45% return and a negative 0.7% contribution to return. And Intel is still struggling to compete in the artificial intelligence market, and their competition from AMD and NVIDIA are putting them behind in the race for reducing their advanced chips. Next, we have Applied Materials, who had about a negative 28% return and a whopping negative 1.27 contribution to return. They have been affected largely from the global slowdown in chip demand as one of the largest semiconductor manufacturers. And additionally, security risks have restricted their exports to China. And lastly, we have Turtle Beach Corporation, who had about a negative 26% return and a negative 0.25% contribution to return. This is mainly due to the decline in enthusiasm of their gaming accessories since the post-pandemic gaming boom. And then next, Joey will be talking about sector weights and returns.
All right, so one thing I want to point out about our sector weights is that they are different now as we are switching to an RBICS sector breakdown with Dr. Starnes' confirmation, as FactSet no longer offers the GICS breakdown, which is the standard model that we use with the S&P 500. So this is a new look for how our stocks are being broken up, but as you can see, all of our stocks still fall within our 5% guidelines, which is important to know. But telecommunications and business services sectors now do not have any stocks in these sectors because of this new transition. So then, looking at our sector revenue analysis, this is something that we brought up last semester, and one recommendation you guys had for us was to compare this to the S&P 500. So this is taking each company's revenue streams and then allocating that based off of their sectors. So this is just a different view of looking at like a sector breakdown in comparison to a main revenue stream and then categorizing the stock base in that sector. So as you can see, there's not any drastic differences, with industrials having the highest difference for the Spellman fund being overweight, and then consumer non-cyclicals being about 4% less than the S&P 500. So again, this is just like another way to analyze their stock sectors and just how our revenue streams are broken up. So looking at sector returns, consumer services had the largest gain in comparison to the S&P 500, beating it by about 5%, which was driven by Booking Holdings' strong return. And then non-energy materials had still a negative return, but about 5% greater than the S&P 500. And then looking at our three worst sectors, performance in comparison to the S&P 500, utilities had about 17% less return than the S&P 500. And this is driven because there's only one stock in the utility sector. So this sector's performance is based only on that stock's performance. And then business services and telecommunications, as I previously said, do not have any stocks in these sectors, and it so happened to be the S&P 500's top two performing sectors. Next, we'll talk about attribution effect.
Okay, so moving on to the selection effect, as you can see, the biggest number up there is the technology at plus 0.69. And that is mainly due to our selection of SAP and Netflix, which had very positive returns. And then the next one is consumer services. Again, mainly just brought up by Booking Holdings. However, those last two at the bottom, mainly utilities at minus 0.4, which was actually one of the S&P's best performing sectors. We didn't do very good because our one stock in that sector performed very poorly. And then for consumer non-cyclicals, again, just mainly brought down by CVS Health, which was one of our worst performers within the fund. And then looking at allocation, so that biggest one up there is energy at plus 0.36, which was actually our worst performing sector. However, we were underweight in this sector, so that turned out to be a good thing for us. And then the bottom two, which I think are the most important, are business services and technology. Again, business services, we have no stocks in that sector, so that weighed greatly on our performance. And then technology, we are a bit overweight, so that might be something we want to look for in the future, maybe trimming our technology holdings. And then finally, the total effect. So again, those made to the top energy technology, mainly because of their selection and allocation effect. And then at the bottom, non-energy materials, we only have one stock in that sector, and we were actually pretty poorly for selection and attribution effect in those. And then business services, again, that's kind of the big problem. And that's something Joey will talk about next, or Charlie will talk about next.
Thanks, Sean. Before I begin, we just wanted to remind you guys that these recommendations will be for next semester students to look into and explore a little further. With that being said, because of the transition from GICS to RBICS sectors, we recommend diversifying into the business services and telecommunications sectors, as we currently hold 0 stocks within those sectors. Moving on, because tariffs continue to be a thing and because of market uncertainty, we recommend focusing on domestic firms and increasing exposure to less trade sensitive sectors like utilities and consumer non-cyclicals. Coincidentally, we only hold one stock within the utility sector, which kind of aligns well with that recommendation. And then finally, business services face minimal exposure to tariffs. We wanted to highlight this as another kind of, driving home the point that we want to, maybe look into business services as being a sector to look into. And then these are upcoming Spellman Fund presentations. I'm personally excited to see JPM because Noel will be presenting that as well. And yeah. That being said, thank you guys for your time, and we'll leave it up to you guys for any questions, comments, or concerns.
Were you all on this last semester?
Yeah.
Yeah,
Okay.
and last year.
And last year, so you guys just keep seeing our faces.
Yeah,
It's
that's great.
So it's all right.
You're part of the actual group this year?
Yeah, so JP Morgan.
Okay. Awesome. First though, good job. I like the explanation of the allocation effect. like the explanation of, Sharp ratio. These keep getting better, I always like the comments, so I don't really have any questions.
Yeah.
So when you guys say, suggestions, like I said, be for next fall, which makes things a little challenging.
Yeah.
So I'll ask silly questions, because do you guys, did you come into the spring class in the beginning and actually rerun this presentation and say, okay, here's what we suggest you guys have?
No, but we had on when we were first picking stocks, there was a section that said that we recommend these specific sectors for other groups to look into. So it was on there.
I would rewrite this.
As in, were those sectors good? Oh, that's a great question. I don't know.
That's not the answer.
That is a great question. I'll look later. Maybe I'll tell you later.
So yeah, it was definitely.
Yeah, I'm sure, but,
Good.
so yeah, just we had recommended that they look into those. Yes.
I would suggest, future groups, I don't know what are you guys planning on taking this class next semester? I don't know where you are.
I'll take it my second semester next, year, so it's this time.
I would suggest you guys go in and have the time, and actually give the presentation to the class at a time, look at what we do today, kind of factor that in, you don't have to read everything. It wouldn't take too much to obviously run your numbers again and say, hey, here's what happened, here's kind of what you think you should do. Here's some areas you should focus on. I think, just showing a slide to the students, probably not as powerful as the peers coming in and saying, hey, we've done the work.
Yeah.
And step it up.
You got a blind squirrel finds an acorn once in a while.
Sure.
I got a question on the sector. I'm not as familiar with the RBICS. Do you have an example of what a business service company would be?
Yeah, so that would be H&R or any company that's doing services for other businesses, so. We looked that up.
I just looked, I don't remember.
I couldn't tell you any more than H&R Block, but I just know
It's
that.
only about 2% of the S&P.
Yeah, it's not weighted very heavily, nor the telecommunications one, but they did see what's strong.
The telecommunications is like Verizon and AT&T.
Yeah, so Verizon is presenting.
Yeah.
Overall, great presentation. I think the content that we would like to see and anticipate to see in terms of a review and attribution review. Just one comment on the first slide. You mentioned in your comments when you're talking about the Sharp ratio, you're accurate in that. I think it'd be useful. You have the return to also show the standard deviation, so we can see that number.
Yeah,
When you're, and then obviously you have this Sharp ratio with that calculation. But that'd be easier to visually see, okay, underperformed, had a little bit more or less standard deviation, but the underperformance was still more to offset that.
I think it was 1.13 for the Spellman fund, S&P was 1.12, so.
Okay.
So pretty close, but still slightly lower.
Thank you.
And what else is putting here? Oh, reading down, there it is. Just kind of curious, the other thing that kind of popped in my brain is what's been the performance since we've added so these things, just out of curiosity.
I know Occidental Petroleum had a strong stretch, but then energy obviously saw a big downfall. Home Depot had a strong return. I think we talked about that last semester. Fastenal had good returns
Fastenal
too.
was good. They had one good earnings report.
Yeah. And then there hasn't been too many other times.
It was like up and down.
Would this be a fair statement? In any given sector, the stocks that we hold are the suckiest ones in the sector? That'd be the overall
Can you
picture
go
that
to
you're saying?
attribute?
Yeah.
Oh, wait.
Selection.
Oh, yeah. So I mean, business service, telecommunications, both 0. So I mean, yeah, majority of them are negative, not positive, so.
They're not all discussed this.
No, well, wait, go to.
So like,
go
yeah,
to
I was gonna say like a good example of like one that we outperformed would be, would be consumer services with, Cooking Holdings, they have one of the starters in that sector. And that drove our fund return up. Yeah.
I was a little confused by your color in here.
Yeah, I
think
know.
figured that out.
I was matching it because I felt it would be more beneficial compared to just like the top performance. Compared to us, it's way better than what's there.
You know, what you could have done is just like, to make people visually see this easier is. So you've got your return, you've got the S&P return, the difference is,
Yeah,
obviously goes positive and negative, then you sort of color that.
yeah, I think we have that, is that in our report?
Okay. But
Oh, that's a revenue breakdown, but yeah. I think-
So your fund returns, are you including the dividends?
It's total return, so it should be. Like, dividends. I don't know what the dividend return would be, but. Got it in there somewhere.
Well, we have, I think Nextera is the only utility we have.
Yeah.
We have 1% perhaps, and I was wondering if that was half.
You should be.
They have one of the lower. Yeah. One of the lower dividends. Well, we can-
Well, thank you guys.
Thank you.
First off, thank you all for taking the time to be here today. We're excited to present our findings on GE Aerospace. My name is Steven.
I'm Cole. I'm Jared.
Jacob? I'm Owen.
I mean,
So briefly, we'll go over the outline. We're going to talk about the business overview, revenue breakdown, the risks, financials, our key growth drivers, and then our valuation and how that might fit into the Spellman Fund. So we wanted to briefly go over the General Electric split. This happened in April of 2024. And essentially, General Electric, the conglomerate, split up into 3 different companies, one of which being GE Aerospace. So just to reference all of our historical figures, they come from General Electric up until GE Aerospace took over the GE ticker in April of 2024. So their business model is pretty simple. They design, develop, manufacture jet engines and aerospace systems for commercial and military aviation. So they do it all, anything from your typical 737 to fighter jets and military helicopters. Have a wide range of engines and systems. And they're also investing in new aerospace technology like cleaner, greener, more sustainable and efficient engines so that they stay ahead of the curve and continue to be a market leader in the future. And they make money by selling these engines and spare parts for these engines, whether that's commercial or military, and then primarily through long-term service contracts. So when a customer buys an engine from GE, they can sign into a contract, typically ranging from 10 to 20 years. And they use a power by the hour model. So anytime a GE engine is in flight per hour, they pay a flat rate back to GE in exchange for spare parts, service, maintenance. And so to put it simply, when a GE engine's in the air, we're going to be making money. And these engines are just money-making machines for decades to come. So we're recommending a limit buy at 205. I'll get a little more into that in a second here. But like I said, due to the split now, they're a much more focused company. They're a pure play aerospace company. They have a lot lower diversification and they're a reliable company. They're very defensive with all these locked in reoccurring revenues for a long time to come with a good backlog. And then they're well positioned being a market leader in the aerospace industry. It's a hard industry to break into. And they have good relationships with their existing customers like Airbus, Boeing, the US military, and their allies. And so to be a little more specific, we're recommending a buy of 20 shares. This would be around 1% of the Spellman Fund at 205. And so our current price is trading right around, I believe, just look 214, with our target price being 229. And so the reasoning behind our limit buy recommendation is because we just wanted to maximize return. And if we were to buy right now, we don't think it would offer enough of a return. Just in the last month, they've had around a 27% increase after the tariff news. They were trading as low as like 170. And so we've made a pretty full recovery since then. So we went from being a strong buy to a little weaker. And now we're recommending the limit buy just to maximize that return. So if we got in at 205, target return would be just over 12%. And we feel that is a little more attractive than, let's just say, a normal investment in the S&P. And so our key drivers for this are the rebounding demand in air travel and defense and military contracts. And then our key risks include the tariffs, just increased costs, as well as supply chain issues. We struggle with spare part shortages in the past. And then consumer dependence. Like I said, we do a lot of business with a few consumers like Boeing, Airbus, and the US military. Just a visual at our stock price the last 12 months, can see pretty steady growth with a few bumps in the roads. Right now, we are at a high, and that also goes into that limit buy recommendation. We feel there might be a little bit of a correction. It would be a better time to get in. And I'm going to pass it over to Anthony to talk about the revenues.
So on the top of the screen here, we have the historical revenue from 2023 to 2019. As you can tell, these numbers are pretty extreme to the number at the bottom there. This is due to the fact that those numbers were when GE was the company that, this is before the separation of GE. So GE Healthcare, GE Aerospace, and GE Vernova, they separated from GE, as Stephen mentioned. So those numbers are a little inflated. But going to the bottom, you have your 2024 revenue breakup. The first revenue stream we had was commercial engine and services, which made up of roughly 70% of our revenue, or their revenue. Then defense and propulsion technologies, which made up of roughly 25%. Corporate and others, 6%. For a total of $38.7 billion of revenue. Here we have a snake graph of the 2024 income statement. On the left in the gray are the revenue streams I just mentioned on the previous slide. You have your gross profit, cost of goods sold, and then what I want to point to your attention specifically is the non-operating income at the bottom. It's an extreme number for a company, but this is due to the fact that they had large investments in GE Healthcare. And then additionally, they have other miscellaneous revenues that came with separating the separation. Here we have our risk matrix. On the bottom left is physical risks, which is weather, damage in warehouses, military contract reductions. We have this relatively low because this falls in the defense category, and we think that's a pretty robust revenue stream. We're pretty optimistic about it. So we don't see it changing much. Carbon emissions, this is regulation changes or CO2 laws that get put into place. This could potentially lead to GE Aerospace having to shift how they make their engines. And then you have consumer preference and unsuccessful investment in new engine technology. These kind of go hand in hand. As a company progresses, you have to invest in new technology, incorporate that into your engines. So if GE doesn't maintain their competitive edge, they'll lose some customers. And then on the right, you have the trading war, which addresses the tariffs, and we'll get to that later in the presentation. Here we have financial ratios over the past couple of years. So in 2022, GE struggled with inflation, and it led to some poor numbers that year. And then 2023, they recovered slightly. 2024, they made a further recovery. And then there you have your TTM, your trailing 12-month. Following that is RTX and Safran, which are some competitors with GE. And then you have your industry average. So what I would like to talk about is how the TTM, you have your price to book, your ROE, your ROA, your net profit margin, and your DE. Those are all higher than the industry averages. And then you look at the PE ratio, and it's lower than the industry average. And that kind of illustrates how it could be considered undervalued. Next, I'll talk about the debt, and this information is as of December 31st, 2024. So their total debt is 19.3 billion, but this kind of goes along with their cap-intensive business model. Following that are some miscellaneous notes that are due over the next decade. And then you have your average cost of debt at 4.7%, and this is a firm number, so it leads to a small annual interest payment of 0.8 billion. Debt to equity ratio is 0.88, and then the debt to capital ratio is 75% or 45%, excuse me. And those two figures kind of illustrate how they leverage debt to support growth while maintaining balance sheet flexibility. Next, I'll pass it off to Owen.
Thanks. So getting into some of the growth opportunities that we've identified, the first one is increased air travel demand. So in Deloitte's annual report on the air travel industry, they projected 11.6% increase in air travel demand over the next year. And this is a rebound from the drop off during COVID. That air travel demand has rebounded fully and has surpassed pre-pandemic levels and is expected to continue to grow. For GE, this is pretty significant because, as Steven mentioned, anytime a GE engine's in the air, GE is making money, and so more flights means more engines, more wear and tear on the engines, which is higher revenue. So industry analysts, the aircraft engine industry, have projected a 9.8% compound annual growth rate over the next 5 years, with commercial engines and maintenance making up around 70% of GE's overall revenue. Is a pretty significant opportunity. And we can already see this come to fruition in their Q1 earnings. Equipment sales are already up 9% from Q1 of last year, and services revenues are up around 17% from last year as well. So to get into some of our assumptions and calculations, our key assumptions, that 9.8% compound annual growth rate. We're also assuming constant profit margins and market share over the next 5 years. This leads to a somewhat conservative estimate, as with most manufacturing businesses, you can kind of assume increasing margins with continuous improvement and increases in efficiency. But going from our most recent $27 billion in revenue in this segment, accumulating that over the next 5 years, we get to around $43 billion in 2029. Applying our 26% profit margin gives us around 11 billion in profit, and this leads to a $10.49 contribution to EPS in 2029. And then for our scenario analysis, our pessimistic scenario is mostly based on tariffs not going in GE's favor. So if the increasing production costs leads to prices going up too high, and then the consumer, we lose customers. Additionally, if trade wars are like retaliatory policies by foreign countries, decrease in exports. And then on the optimistic side, we have a 12% growth rate, and GE's already outlines some of their strategies for tackling these tariffs. One of them was a tariff surcharge, so just directly building the tariffs into the price of their products. Another one was utilizing foreign trade zones where they can kind of work around the tariffs by assembling stuff outside of the country, so that you don't have to pay like a higher duty on each component. And then the CEO, Larry Culp, has been meeting with President Trump to negotiate and try to get lower tariffs or eliminate them altogether for the aerospace industry. I'll be passing it to Paul to discuss the defense segment.
Yeah, so for our second driver, we'll be looking at defense and military contracts. So we found that there's increased government spending on defense and military contracts, as well as more investment in military aircrafts, drones, and satellites over the next 5 years. And GE would benefit from this because they supply some of the engines and key components for these defense systems and military aircrafts. And then the US defense spending is expected to grow around 3 to 5% annually, and this is taken straight from the Department of Defense projections. Defense spending, as we kind of mentioned before, it's more of a stable and robust revenue stream compared to commercial travel. Again, as we mentioned before, 24% of GE's revenue already comes from the defense and military, so we see even more growth there. And last year, Congress passed a bill to increase their defense spending budget around $30 billion. So looking at some of our assumptions, as I just said, the US defense spending grows around 4% annually, so we use that for our growth rate. And then we took a starting point of 9.4 billion in revenue in 2024. And then we applied the growth rate to that over 5 years to get around 11.4 billion in revenue in 2029, which is about a $2 billion increase within those 5 years. And then
we took that 2029 profit and applied the 11% profit margin to that to get around 1.3 billion in profit. And we took that profit over the shares to get around a 1.2 EPS contribution in 2029 for this driver. So looking at our two scenarios, we'll start with the pessimistic. We still project around a 3% growth rate, and this is where, again, tariffs would stay in place, which would make it harder to sell to other countries and therefore lower demand from some of these international buyers. Growth would still happen through some of the US defense contracts. That's why we use the 3% growth rate, and we're still have somewhat of a positive outlook on it because the US is where most of their revenue comes from in this section anyways. And GE may have to lower their prices just to stay competitive in the international market. And then looking at the optimistic side, we project around a 6% growth rate. And this is where, again, tariffs are removed. Other countries would then buy more of their defense products, and overall global demand for military equipment would go up as well. And then their strong backlog and maintenance work would allow them to keep their revenue growing and steady over time. Now I'll pass to Jared to talk about valuation.
All right, so next thing, look at our baseline UPS breakdown. We broke this down into 3 different categories, which was travel demand, defense, and other. So for travel demand, we used a 9.8% growth rate, and then for defense, we used a 4% growth rate to calculate our total EPS. And this was compared to our industry growth rate of 7.3%. And then furthering this, we have an optimistic and a pessimistic outlook. So for the optimistic outlook, we use different growth rates to give us our optimistic EPS. So we used a 12% growth rate for travel demand and a 6% for defense. And then on the pessimistic outlook, we used a 2% growth rate and a 3% growth rate for defense, which gave us an as well. And then breaking down our PD method and our discounted cash flow method, we use for PE, we use our 1-year ahead PE and then our 1-year ahead EPS, which gave us our target price on the right for each of the outlooks. And then for our discounted cash flow method, we used the average of the two values to give us a target on the right. And then we decided that our stock better fit with the PE method. So we used an 85 to 15% weight, which gave us the target price on the right for each of the outlooks compared to our current price of $213.30. And then next, Jacob will talk about our portfolio fit.
All right, so I'm gonna talk about the portfolio fit. So currently, the Spellman Fund has no position in the industrial manufacturing section, and we think that GE Aerospace would be perfect fit for this to help diversify the portfolio. Again, we recommend buying 20 shares of GE at 205, and the correlation is 0.46 with the stock, suggests that there's a moderate positive relationship. So this would mean that it's fairly aligned with the fund's performance. And then kind of summarize our presentation here. So we think that GE, they're market leaders. They're constantly investing in the future. There's always more room to keep developing newer engines and better technology. And they have strong growth drivers. There's surging demand for air travel and stable defense contracts. And they're industry leaders. They're well positioned for long-term growth, even after the post-GE split. We think there's plenty of growth opportunity for them. So again, we're recommending a limit buy at 205. We're going to purchase 20 shares of GE. And the target price we're looking at is $229, and we're looking at a target return of around 12.5%. Thank you. Good questions.
Do you guys do any work on revenue breakdown by geographical area? Like how much of the revenue comes from Europe, Asia?
I looked at some of that. I don't have like specific numbers, but I know like specifically for the defense contracts, I think around 5 or 6 billion came from the US alone last year, and the second most was like India at like 720 million. So that's why we're saying it's mainly US based, but I don't think we have specific numbers on that.
Where I'm going, I'm just kind of curious because depending on what that answer is, tariffs can mean much less of a conversation. If the majority of their income is derived from the US, then I don't care what their efforts. You could, if you didn't want to have, if you weren't already established in Europe, say, okay, well, that's not a sustainable,
It's a supply chain. Where do they get raw materials from?
I
What does the
think,
supply chain look like?
I think their main two are Mexico and Canada, I believe. So, yeah, that's the issue.
So also, so the question on your pessimistic view is still has a several percent growth in air travel. What leads you to that? I mean, like, given the whole geopolitical world at the moment, where is this air travel happening? Is it just within the United States, between countries? What's your sense of sort of like?
Well, in terms of the pessimistic growth still being a positive growth, we're mainly thinking that just because of how defensive our company is, and most of the revenue is with the reoccurring income. So that's gonna like be a stable just growth for them, even if our like the tariffs are in play. We don't think it's gonna have like too much of a hit.
No, I guess maybe I misunderstood one of the slides. Didn't you have sort of the slide that talked about robust demand growth? Like what are the views for air travel?
Yeah.
So 10% compound annual growth
Yeah,
continuing.
I mean, that's just, like industry analysts are expecting that. And even in like I guess like the, I guess the,
there's two, to go back to the slide. So there's two different statements that are there. You have air travel demand growth and growth in commercial agencies. So you know, just demand growth, but at the end of the day, there's a huge bit of Boeing and Airbus. There's a huge backlog of planes that have to be built regardless of that air travel. If I have a contract with Boeing or Airbus, they have to produce the planes, which means they have to put engine engines on the plane. You know, they're trying to predict what that air travel is, but it is not the planes, so it's not necessarily that.
Okay. So I mean, you can cancel contracts, but okay. Now then the next one, revenue here, you projected pretty robust revenue growth because you argued that they're gonna get more productive. Make higher margins on their manufacturing.
no, that was more tied to the demand, like the increase in demand, which leads to the increased sales in the commercial aircraft, like engine.
Okay, but you said like, so there's increase in. Which is it, I mean, someone made this statement about margins improving.
That's kind of like a side point.
Okay,
'Cause
so our
like
margins are you predicting margins are gonna improve or not?
No,
You don't think that? And why'd you mention it as a cycle?
that was just, kind of like talking about how this could be viewed as like a conservative,
Okay,
estimate, because like typically in manufacturing businesses, margins do improve over time, but we're not.
in this case, do you think they're gonna improve or get smaller?
I mean, in this case, we're just assuming that they would stay the same.
Do you think of any reasons they would get smaller?
I mean, tariffs maybe with like rising input costs, but.
Tariffs, let's forget about tariffs for the minute. What's happened to the dollar in the last month? 2 months? You forget about tariffs, like you just, there's no tariffs. What's happened to the value of the dollar? Good guess, by 10%, right? So that's any inputs you have, no, even if you forget about the tariffs, you have a 10% increase in cost, you know, relative to what it was just 3 months ago or 2 months ago. That squeezes margins there, and anything that's sort of you're importing, right? So.
Unless you had offsetting sales. Or hedging programs in place, which is why they have zero foreign exchange gains or losses on the financial statement.
That would be the answer. How far ahead of the head?
I got a question on your, recurring revenue. It seemed like you mentioned that a couple times as potential, positive for this business. Do you have a split between in their commercial engines? How much of that revenue comes from the one-time sale, versus the recurring revenue?
Only have the number, they're like. Forgot what the term was. We have the number, but it's not, it's slide back.
Of their backlog, at least, it's around like 170 billion, and there's 140 billion of that, which is just the service revenue on backlog, so that's probably over the next 10 to 20 years, like I mentioned.
Is it 50-50, or is it leaning more recurring or more of the one-time sale? Do you have a sense of that?
Definitely more the reoccurring, but we don't have the exact number on that.
As a follow-up then, as it relates to the types of planes that they're engine and utilized for, is it more domestic travel, smaller planes, or international? Is there a split, or is that not a big difference?
They have a wide range, to be honest. Their most recent orders are from Korean Air for around 30 planes, another Japanese airline for another 30, and then.
Let me restate, is the engine, being utilized in large jets that
Yeah.
go internationally?
Yeah,
In
like-
terms of the travel, or
Yeah.
more shorter trips?
737s, Airbus A320s, like definitely commercial engines, yes.
Piggybacking on that, on the hourly revenue.
Yep.
So that includes also the cost of maintenance and parts. So how profitable is that actually? I mean, we're looking at the revenue, but. What that hourly revenue margin might be?
I looked into it, and like typically the hourly charge like the flat rate might be from like $150 to $200 per hour. So if a plane were to fly like 3,000 hours a year, that would be like $500,000 in revenue for them. I'm not sure what the specific like profit margin is on that.
Because the revenue is important, but it's always expensive.
Yeah.
Yes, the other thing is, if you think these hourly contracts are fixed or are we adjusted for inflation?
They are fixed, I'd say.
So as we go along, it's not really worth as much.
Right. Yeah, that's a argument, like you might not make the same returns in 10 years, that you will for the first 10 years, due to that, yeah.
Help me understand the use of a limit order on this recommendation.
So up until yesterday, honestly, we were recommending a buy. We just had, it was a pretty moderate return of like 7%. So that's not like a crazy high return. And like I said, in the last month, they've had a pretty significant recovery. So we were a really strong buy a couple weeks ago, and it's just kind of slowly lessened as the prices got close to our valuation. So we don't think that's a crazy amount to come down to get in at, just to capitalize a little more turn. But
What are the risks to using limit order?
I think it can skip over it and not get filled, maybe. Yeah.
So in your assessment, absent the move over the past day or two, I mean, so you have a 205 limit price. So we're looking for maybe a 5% pullback if not even.
Yeah, which like just on Wednesday or Thursday, I think they're up 4% just on the day. So that's when it kind of took a hit to our valuation a little bit. Maybe not necessarily a limit buy, but just like a target price to buy around. Just not right now is where we want to get in.
What was a big driver for the price spike earlier this year? If you ignore the tariffs that came out in April, the stock's been pretty consistently trading about 200 most of this year, whereas before it was around 160. You know what might have driven that price increase in January?
I think I know they have a lot of orders that have been recently secured, specifically just with the US government, up to 5 billion contract for the F-110 engines. It's like a uncertain quantity and time for that contract, but they had a really strong Q1. They exceeded earnings and expectations, so that could possibly be the reason for that, but.
I've got good news that many of my questions have been almost answered.
Okay.
Chad. And I want to start with the limit order. Are you convinced that we want to own this? And if you're convinced, then would you still buy it at current prices? Have you heard that?
Yeah, we talked about like scaling in possibly, but we do have, like, with our optimistic valuation, there's still a lot of room to grow. And so even getting in now, I think would still offer the Spellman Fund benefit, just like we said, diversification. And this is a good sector to be in, and we don't have any investments in it yet, so it still would be a good investment for sure. We just tried to make the target return a little bit more investor attractive.
And the backlog, I don't understand that. Is that GE's backlog? Is that Boeing's backlog?
That's
Is that a combination of those?
GE's backlog.
Okay, so GE fills their backlog and sends a bunch of engines to Boeing, who is not building airplanes on time. Is Boeing accepting them, or is Boeing pushing them back?
I know, like, just talking about with the tariffs with China, Boeing's halted all orders to China, which is only like 10% of Boeing's revenue. So it probably wouldn't take too big of a hit on us. But I also know that I think they're just building that capacity right now. So
Well, Southwest Airlines can't get the airplanes they're ordering, and that's not China. United Airlines can't get the airplanes they're ordering. And so that there is a backlog at their buyer. And is that going to impact our backlog, or is that already part of it? So do we have a backlog here, or is it somewhere here where we have to focus to determine whether or not GE can put the engines on the wings that are going to get the recurring revenues that we're looking for?
Right.
I don't know that we know that.
Yeah. Not sure we looked into that.
I had a similar question on profit margins, because I heard the same thing and I didn't quite get that, but if in fact the costs do increase, is that a transferable cost, or have the contracts already been signed at cost?
I'm not too sure on that. We'll have to look into that.
Yeah, and the reason I asked, I just heard, I don't know that this is accurate yet, but if 40% of the cost that GE is charging is the import cost, and they increase the entire cost by the cost of the tariff, they can improve margins. Just by saying tariffs went up, and I can do that. I don't know that's the case. And I know I'm asking a lot. Can that happen? Where is GE in that whole in that value chain? Where do they get the opportunity to pass that along and possibly even improve the margins? Or are they stuck, in which case the margins shrink to nothing?
Yeah, I think we had our profit margins like kind of remaining flat, with the tariff costs offsetting the growth in the commercial sales. So that's why, like, our pessimistic outlook wasn't a negative profit margin, at least, just because we think it'll kind of cancel that out.
No. 24. The optimistic is we're going to see a multiple expansion. Too pessimistic, we think we can see
An explanation, and if it's a typo, it's a typo. Just curious, there's one thing about me. Pretty sure it's a typo, it's a typo, okay, yeah, just the life lesson, always go through your stuff, check it, is, my old director of investments is that if a client sees something wrong on one slide, he's gonna assume that he or she's gonna assume the whole thing. So it's always constant, so just something to think about, you guys are really helping us. Always be nice and work we put out and make sure that's correct. It happens. Right? But we hopefully catch it.
That's one we can talk about, not having this represented in the portfolio currently. The biggest customer is Boeing. We would rather manufacturing that supplies Boeing. Don't we then subject ourselves to the same. Risks?
We were originally gonna say that you should sell like half of Boeing and then buy this, but
And then, in terms of your global sales, US is the biggest part. India was like close, and then anything go down, yeah, the last two biggest orders were Korea and Japan, so you just highlighted two additional countries where we have exposure. It looks like it's about 50-50 global sales versus US sales. It's quite possible that all of those sales are denominated in US dollars, but that just pushes the currency risk to your end customer, which can be fine. Which might be why when you look at financial statements, you never know the currency risk is an issue. The other thing that could offset it is, where is your manufacturing? So are you manufacturing in Japan for the thing to sell to Japan, and manufacturing in Canada for the thing to sell to Canada, or is everything manufactured here? In each of the various congressional districts, so that you can override strings when you need to. But it's all US manufacturing.
Yeah.
That's both, that was a big statement, like. Well, isn't that, the group that pitched was Lockheed Martin, where they strategically have manufacturing in every single. Various congressional districts, just to, have a little more calm. That was too many really nice. Thank you very much. Yeah, good job.
Good afternoon, everyone. I'm Rylan,
Medium?
Austin. Jake?
and today we are going to be talking about Verizon. So to do a quick agenda for today, we're going to be going over the business overview followed by the revenue breakdown. Moving forward, we'll be going over the risk and financials of the company and going over the key growth drivers, which we believe are expansion of fiber services and wireless service expansion. Moving on from there, we will go over the valuation of Verizon, followed by our recommendation as to whether or not Verizon should fit into the Spellman Fund, and then we'll wrap it up with our summary. So to go over Verizon as a business, Verizon specializes in communication, technology, information, and entertainment products / services. Verizon is broken down into mainly two groups, the largest being Verizon Consumer Group, $103 billion in revenue worth, and the second largest being the Verizon Business Group with roughly $30 billion in revenue as of 2024. In addition, Verizon also has a Verizon Frontline Services, which works on connecting various emergency services throughout the country with over 40,000 agencies subscribed to it. In addition, Verizon also serves customers in over 150 countries, which demonstrates the demand that Verizon has worldwide. So in regards to the Spellman Fund, we are recommending not to purchase shares of Verizon. This is due to its limited growth potential in the industry that it's in, the telecommunications industry. In addition, Verizon has a high level of debt. As we've seen Verizon grow as a company, it seems to take on a relatively large amount of debt that raises some questions for us. In addition, Verizon has a large amount of bonds that will be maturing in the next few years, and we are quite concerned to see how they will work on repaying those bondholders. In addition, Verizon has a earnings per share and cash flow that has been relatively stagnant over the past 5 years. And we can see in the top table in the earnings per share
As of 2024, earnings per share was at $4.15. And most notably in the cash flows in the bottom table there, it has been trending downwards for the past 5 years, bottoming out at $37 billion estimated. So a brief overview there. We are again not recommending the addition of Verizon to the fund. Going over our target price later, it is as of today valued at $43.75 per share with a target return of 1.76%. Going over the business, again, we believe that Verizon has a lot of debt for its company. And in addition, it does offer some relatively high dividends at this time, though. It is underperforming compared to inflation, so that could change in the near future, but unsure as of now. Going over to our key drivers, which will be discussed later, we think that our wireless service expansion and Fios/fiber internet expansion could be of note. And lastly, our risk of economic constraints and competitive pressure could play a role in Verizon not doing as well. Going over our revenue streams here, we can see similar to the earnings per share and cash flows, revenue has stayed relatively stagnant for the past 5 years, not trending up or down in any specific way. Going over into our 2024 more in-depth breakdown of revenues, we can see that the consumer segment brought in roughly 76.2%, followed by the business bringing in roughly 22%. And lastly, there is a corporate segment that Verizon has, which specializes more in insurance plans and investments in businesses that Verizon believes coincides with its strategic goals. So to cover it up with some key statistics here, we have a price earnings, ROE, and earnings per share for the past 3 years, followed by a trailing 12-month. And over to the right side, we have a graph depicting the trailing 12-month stock price, followed by the last 5-year stock price for Verizon. So with that all being said, I'm going to pass it off to Ian to go over the risk matrix.
Thank you.
Oh, sorry.
So as we are discussing, there's many risks with Verizon. Big one is going to be economic contraction. I'm sure as many of you are anticipating, we certainly can see some economic contraction in the future. And although a lot of consumers are not looking to fully stop paying their phone bills, customers value phones very highly, as I'm sure every person in this room has a phone on them right now. However, they could be downgrading their plans, as in if they were on unlimited data before, they could be going down to a limited data plan moving forward with less money in circulation with lower income. With technology advancements, we are certainly going to see some more in the future. Over the past 5 years, we have actually seen the 5G jump. So I'm going to get more into that a little bit later, but can Verizon hold up in the short term from what I can see? Certainly, they've expanded the 5G network vastly over these past 5 years, and I think that they can continuously do that. The competitive pressure from T-Mobile, I just looked at it today, and unfortunately, this is going to be a large doozy. The latest figures I found out from 2024, the new customers are about 80,000 for Verizon, and newcomers for T-Mobile are about 3.1 million. I think that's about just shy of 40 times difference. So that's a very large gap there, and I'm not quite sure if Verizon's ever going to be able to close that gap. One idea I have behind that is certainly their marketing strategies and their promotions possibly could be a big reason why T-Mobile is outpacing Verizon in that stretch. So now I'm going to pass it off to Mike.
I'm going to talk a little bit about the financials for Verizon. Looking at Verizon's PE ratio, it's trading at around 10.09 right now with PE ratio, which is below the industry average and a little bit lower than the biggest competitors in AT&T and T-Mobile. Its PEG is around 0.18 right now, which is below the industry average. Its price per book is about 1.8, which is a little bit lower than the industry average, and it really hasn't done anything to increase in the recent years. Its ROE has been pretty much stagnant or declining over the last few years. It still is in par with the competition of AT&T and T-Mobile, but it's above the industry average. It's just not growing as we kind of want it to. Its ROA is right where it kind of needs to be at 5.15, which is above the industry average, and just still there, staying pretty stagnant, as well as the net profit margin slightly above the industry average at 13.14, and just pretty much plateauing in recent years. The big thing here on the financials that I want to highlight is the debt to equity ratio. The debt to equity ratio, looks like it has declined over the last few years. It's around 1.7 right now, but it's still significantly above the industry average of 1.29. And I'm going to pass it over to Jake, who's going to talk a little bit more about the debt problem for Verizon.
Thank you, Mike. So getting into the debt of Verizon, we already mentioned before that they have a large amount of debt. As of December 31st, 2024, $144 billion worth of debt, 22.6 of that being short-term and 121.4 of that being long-term debt. And approximately 21.2% of this debt is foreign denominated, and around 118 billion is unsecured debt. So the effective interest rate on that debt they had outstanding was around 5.1%, which is higher than their competitors AT&T and T-Mobile, which are at 4.2% and 4.1% respectively, with $123 billion of debt and $80 billion of debt respectively as well. So as I mentioned, Verizon has significant debt, which can cause some problems because high debt reduces the cash available for operations, investments, and stock repurchases. Also, it limits their financial flexibility and can raise the cost of their future financing. And it also makes them more vulnerable to market downturns and interest rate fluctuations. As you see on the bottom, in 2025, they're having $21 billion of debt that is maturing. And their free cash flow in the past years has been right around 19 billion in 2024, 18 in 2023, and 14 in 2022, which raised some concerns for us. So the reason that they have a large amount of debt is their acquisitions they've had in the past, as well as the mergers that they've had in the past, leading to a lot of debt they've had to take on, and also the ongoing debt they need for the 5G expansion. And then on the bottom, I just put some charts that you can see that they're well above the industry average for their debt to equity ratio. Okay, so now getting into the driver one that we found was expanding their fiber services. So their target is to achieve around 35 to 40 million passings in the future. They don't give an exact timeline on that, but a passing is just a residential or business address where their Fios network is physically available. So in the short term, they're looking to achieve around 30 million passings, which would be by 2028. But our concerns with this are inefficient rate goals that they might have, and also installing these networks in high density areas can produce more logistical costs for Verizon. So as I mentioned, 30 million by 2028. Right now they have around 2025, or right now they have around 25 million, which includes those from Frontier, which they're almost done acquiring. And then on the bottom there, I have the growth rate that we anticipated, which would lead to around $15 billion worth of sales in 2029, where right now it's at around 12 billion. So the expected annual build rate that Verizon gives is up to 650K passings added in 2025, and then 2026 and beyond, it's around 1 million. And these technology advancements can enable targeted build outs, and the mobility and broadband can enable more attractive returns in the future, but not in the 2025 year. And then the optimistic projection that we give 2029 around over $16 billion of revenue, but the pessimistic is right around $14 billion of revenue.
Right. Next, I'm going to talk about the wireless services growth for Verizon. Wireless services have continuously been the largest factor of revenue in the most recent years. It's accounted for 48.8% of their total revenue. And just last year in their annual report, they reported $65.3 million in wireless services revenue. In Q1, they delivered 2.7% year-over-year return, and they're focusing on expanding the 5G services. You can see up there is the map of the current 5G coverage. And like I was talking about before, it certainly has come a long way since the initial rollout of 5G. So also in the last annual report, they had 3.2% growth. And the churn rate has also decreased in recent time down to 1.62. That is better than the T-Mobile figure for churn rate. And also for our EPS growth, we have averaged out the last 5 years of EPS earnings and growth off of that, and we decided to be a little bit more conservative. We got around a 4% average figure growth each year. So we wanted to be more conservative at 3% because there's a certain large range. There was 1% here, and then the next year we'd see 5 or 6% growth. So we certainly wanted to be more conservative with that, and we're expecting that to grow 2% annually as a small increase over time. And in the for the pessimistic outlook for the EPS, we are expecting the contracting economy in the future. So to calculate that figure, we looked at the most detrimental economic recession, which was 2008 for Verizon. It created the most impact on their stock. We decided to go off of that for the pessimistic outlook. A very conservative number of 2.4% growth and 2% thereon. And as for the optimistic, we're assuming that Verizon is going to increase their numbers in revenue via promotions and marketing. And they will start at 3.15% and move up 5% year after year.
Now, moving into our valuation, this is a quick breakdown of our EPS per driver. Driver 1 is about 9% of it, and then driver 2 would be closer to 50% with, and then obviously the looming one is the other EPS, which is just taking like phone plans, like hardware plans, insurance plans, and just a lot of the other business they do that's not strictly their wireless. It actually makes up a large percentage of their business. So with all three of those together, you can see the breakdowns and how it would how we've gotten on the baseline for EPS. Now moving into our EPS estimates for the baseline, it's looking at with everything combined, it's looking at around a 2 to 3% growth rate until 2029. Our optimistic is looking at around a 4 to 5% growth rate overall until 2029, and then our pessimistic is looking at around a 1 to 2% growth rate from here until 2029. And then moving into our annual valuation and getting an actual price on what we think Verizon is valued at, we took the PE method completely because, as you can see, our discounted cash flow estimates were way too high. Obviously, that could just mean it's super undervalued, but we found that that historically they've had great free cash flow, and it's just hasn't reflected in the price because Verizon's been at pretty much the same price for the last 10 years, and just has gone up and down, like, I think $10-ish. So heavily weighting it on the PE method, meaning that all these numbers should be a 43. So with the current price of today, all of them would be under the current price of today, except the optimistic, which would be about 24 cents above the current price of now. Moving into the portfolio fit and the correlation matrix. As you can see over there, highlighted is the fund, the Spellman fund. We found that it's actually very low, has a very low correlation with the Spellman fund. It's the if it was in the fund, it'd be the 5th lowest correlated stock in the fund, which would actually do a lot in mitigating the risk of the fund. Despite that, it's not super appealing because there are other better options in the telecommunications industry that have yet to be analyzed.
All right, to wrap things up, we are not deciding to add Verizon to the Spellman Fund because although it does offer a promising dividend return, and although the correlation does fit well with the portfolio, its revenue, earnings per share, cash flows, overall share price is just plateaued and not really seen any growth in recent years. And the high level of debt concerns us. So We have a target price of 41.80 and a target return of 1.76, which leads us to not recommending to buy it. So we'll open it up for questions now.
I'm gonna have more, so maybe I won't catch them all, but what are your risk matrix real quick?
You're with me. There you go.
Okay, so probability of risk, low to high. Significance of risk, high and low. You identify high levels of debt as a low probability, medium significance, and then cited it as a primary reason for not buying it. Wouldn't it be, it already has high levels of debt, so it's a high probability. And if you think it's negative, it would be up in that revenue. That's how I'm thinking of it here. And then Forex rates, we're all of Verizon customers.
They currently are in, the United States, however, they do have international, debt, which could
I
take.
think, I wrote it down as a question, and then you guys answer it later, I'm like, I wonder if they, so that's, yes, they do have that, and why is that a risk?
Transaction rate risk.
If you have debt denominated in foreign currency and the dollar is weakening, it becomes more expensive to pay. So, yeah,
Can I, give a shot at the high debt?
Yeah.
Yeah, you're definitely right. I should have, definitely upped the rate of the significance, of the high, or the probability, because it is certainly high. However, they're refinancing the debt throughout, time. They have some, I think, maybe somebody else was looking into it, for when they're paying it off and the payoff schedule is, significantly down the line, as well as their free cash flow, currently in their, what do you call it, their saved returns, I forgot what it's called, but just throughout time, they're able to pay off on it.
We stick with the debt for a second. Did you forecast the new cost of debt throughout refinancing at today's level? Today's rate level?
We have not, from my understanding, no.
I know they've taken some steps. They've securitized some cash flows and done some other things to try to accelerate the current cash flows. I'm curious, then, are they turning that into some sort of a debt cushion? Are they trying to restructure the capitalization of the organization by doing that? It's a fairly new asset class that they've entered. And I'm trying to assess the impact on Verizon, and you may be inside there, but I don't know if you've looked into that and see what they're doing with the free cash flow. I know it was fine.
No, I have.
That's fine.
I apologize.
give us like 14
Yes.
passing. Heard that before, but, is that passings the amount of population that could get fiber?
Yeah, it's like it's a address that it has the ability to have fiber without like building any more stuff in that area.
So then, do you know what the penetration is, what the amount of customers that are actually utilizing the?
Like per passing, you mean?
For the five, you know, so let's just say there's 20 million passings today. Are 10 million people taking advantage? Is it 5? Like, is there an opportunity to grow significantly, or a lot of people, do you know that number?
No, I don't know it off the top of my head. I think it's pretty low just because not everyone is going to use the passing, obviously, in the area, but I don't know.
So that could be like, the number's really low, that could be a potential big growth rate without even hitting the 35 to 40 million, because there's only 1 or 2 million of the 25 that are customers in this space. Is that a way to look at it?
Yeah, and going off of that too, I know that I've done a little bit more research on this passing just because it can be quite invasive, especially in more urban areas. So those cities that going into that they would like to connect more into, it can be quite expensive for the company. So they would really have to project out to see if getting all this construction would really pay out for the company in the long run.
I used to own shares of Frontier because I own Verizon. And when they spun off Frontier because they thought that business model stunk, I got those shares. Now they're buying Frontier and trying to get back into it. So I'm curious as to how that shifted from this is a crummy, slow growth business to we need to be in this business.
Yeah. Anything to add?
I don't know how large Frontier was, but I mean, my simplest guess would be, this is a guess, but Verizon probably has just more money to be able to throw at the model, the idea of rolling out fiber at a higher level.
It was a $20 billion investment. So 1 year of free cash flow. I think they got more than 5 months. That was long. I did have a question on slide 9, and your industry average. I feel like between AT&T, Verizon, and T-Mobile, those are the bulk of this industry. But when I look at the industry average on the PEG at 4.8, when the entire industry is less than that, or how we got, where did we get the industry average number? I'm pretty sure it was pull up effects. Is that a forward-looking number and comparing it to trailing 12-month numbers, or?
It was a 5-year average, I believe.
Okay. So over the last 12 months, the PEG ratios staying, I shouldn't say staying, they're lower. The negative number throw up its negative growth. So the average is usually 4.8. Slides, well, that's the, everybody else's questions. Your growth slides. You're talking about,
So let me just try and get.
2%. You were expecting 2% growth. That's 2% in the growth rate. So you're saying it's 3% now, but the growth rate's accelerating.
We are.
The growth rates generally accelerate for mature, very large.
And
Might be one of your dividend or your free cash flow number. Is what it is.
To follow up on that, when you guys did the valuations, and you got really high valuations using the discounted cash flow model, did you explore any other models used in the discount model or any other valuation metrics that might be more applicable for Verizon? Just the PE. Yeah. Do you guys know what the dividend yield is on Verizon right now? 6.2%. And what was your projected growth rate of the actual price that you had, like the 12-month? Yes, let me. Might have been a really early slide. I think I did go over that. It was about 1.76, yeah.
So would that target return include the dividend? So you're saying the price will actually fall and the dividend is gonna offset that just.
Yeah, the optimistic is the one that would, the price would actually exceed the current price and then also have to go boost it.
What was your target price? 41.
42.
No.
It's on the last slide. 41.
4180.
So, go to the state of evaluation, you have the various price targets. So as leads perfectly into my question. So you guys got a hold on this.
your baseline is, less than if your dividends, so you're at 1.7%. So if this was just stock in your actual portfolio, you're projecting that we're gonna make 1.5% less than 2%. What? Everything you invest in is relative, right? So if your return is about just 2%. Are there alternatives out there like capital better investing versus a 2%?
Yeah, that's why I recommend not to buy.
But you're holding.
Well, it's not in the fund.
Oh, well, then I'm need to drink what that. But you did say there's other ones that you recommend, but then you didn't tell us which ones.
Yeah, I think we're just referring to like AT&T and T-Mobile, because we didn't explore those as in depth as we did for
Yeah.
Verizon, but those would be the two in the state.
Just assuming there's less supplements. I was confused. I thought you owned it. I mean, you own it first. I own it first, and I'm still learning. We've said no, I think twice. Yeah. And we're trying to figure out why we still. So you can turn the table back on us. You know what? But I looked at it the other day and I counted. And I'm like, whatever it is. So thank you. Cubes, yeah. It was like 18, there's something I saw in there. Like, okay. I gotta do some more a lot of math here. So since I'm looking at the growth of the driver one, the impact to EPS versus the other. So it's essentially like 13 cents for the other and 5 and 3 is 8, so 13 and 8. So your other is actually a bigger impact to your overall EPS growth. I know you guys are not hold or buy that kind of thing. One thing to think about in life is when you have a growth driver. A lot of times, some students come up and talk about here's a growth driver, and it's such a small impact on the overall company. Yeah, there's growth there, but it's a ripple all the time. So that's one thing that I caught. I know you guys talk about it, it's always under stuff, which is fine. So maybe it's not super bad. But the main point of that is just always have the big picture in mind, whether it's like I just started doing quick math in that. Well, that's interesting. Actually, the other issue you guys talk about is connected to that. Don't know exactly what I'm doing. I had a note for this page, but mine was, we're old and have short memories. So rather than say driver 1, driver 2, we remind me what those 2 drivers were, or you change that.
Okay.
But again, that's more of a life lesson. Yeah, life lesson, like just be more direct, and then the other piece of it too is because of the volunteer. I do all these numbers, and sometimes what I've told my groups, I'm sorry, Tom and Brian on this one, but it's not like the actual growth percentage, and it just so you don't have to do the math in your head. So anytime you're doing this presentation, you can make it really easy for people in the crowd versus them having to crunch numbers, because then you're sitting there crunching numbers and they're not listening to it. And I think it's in the fun. Thank you. Yeah. I just thought you wanted it.
Want to grab a picture with it?
Take the time to watch the presentation. The stock we chose to analyze for you guys is Netflix. My name is Conrad Klein.
I'm Ethan Arbridge.
I'm Evan Roberts.
Andrew Scargill.
All right, so just a quick outline of what we're gonna be going over for you guys today. We're just gonna start with a quick overview of Netflix, including their revenue breakdown. Next, we're gonna move on to our risk analysis of Netflix, as well as some financials, which will include some ratios and debt, just some market share statistics that we wanted to share. Then we're gonna move on to the growth opportunities segmented by region. So we're gonna give an overview of every single one of their 4 main regions. Additionally, we'll be looking at their valuation, its overall portfolio fit in the Spellman Fund, and then our overall recommendation and summary.
All right, so just a quick overview of Netflix. I'm sure everybody is familiar with Netflix, so I won't go too into detail here. They did about $17 billion annually last year total, so this will include all 4 of their main regions. Another thing to note, in 2024, they added a subscription-based model to their tier system. So the subscription-based model in the US is priced at $6.99. So it's less than half of their standard model, which is $15.99, and less than a third of their premium model, which is at $22.99. Obviously, they're global. They're available in 190 out of 198 total countries in the world. So that's obviously very encouraging to see. In those 190 countries, they have about 300 million subscribers, and they're increasing globally, not by country, but as internet infrastructure becomes more advanced worldwide, especially in some developing regions, that's where you're going to see some global expansion for them.
Now we're just gonna discuss kind of like where you see Netflix is in the portfolio. As we know, it is a strong stock within recent years with its large growing price. However, we do feel that it is overrated and overvalued. So the reason that this is overrated and overvalued is because the PE ratio is about 60% higher than the industry average. The portfolio communication services is 6.2% higher than the S&P 500. And then also our projected estimation of our target price in a year is currently similar to what it is now. So this leads us to our suggestion to trim. Netflix is also the highest weighted stock. We hold 31 shares of it and it weighs 7.42% of the fund. So trimming now would not only mitigate risk, but you could take back some gains by selling those 10 shares.
So going into this stock's performance over the last 52 weeks, it has gone up over $600 from $555 to $1,159. You can see in the past 3 months, it has jumped up over $300 from around $850 to around the $1,159. So diving into some ratios, I won't go into them too in depth because Andrew will go into them later. But they all are increasing, the PE is increasing, the ROE percentage is increasing, and the EPS, the dollars are increasing as well. So I will let you.
All right, so before we get to Andrew, we're just going to talk a little bit about the revenue overview. So Netflix does all their reporting in 4 main regions. So their first one is US and Canada. This accounts for a little bit less than half of their total revenue share. Moving on, Europe, Middle East, and Africa is also another one of their main regions, which accounts for about less than a third of their total revenue share. And then Latin America and Asia Pacific combined account for a little bit less than a quarter of their revenue share. So taking a little bit of a deeper dive into their revenue, just keep it simple here. Look at the last 4 years, we've seen sales growth in every single region. This is obviously really encouraging to see. Definitely the biggest leap occurred in 2024 across the 4 regions. And I think this could be due, or actually we think this can be due to 2 main reasons. One, as I mentioned before, they had that introduction of their ad-supported model. So this is making Netflix available to more price-sensitive consumers. That could be a main driver of revenue growth. A secondary reason could be their introduction to live sports or live just events in 2024. We saw 2 NFL games on Christmas Day, which saw very high revenue shares. We saw a Mike Tyson and Jake Paul fight. So again, kind of an interesting mixed match of live events. And I think we saw Tom Brady roast too. So this was their first time in the live sports market. And I think this was kind of what was holding them back compared to the competitors. Obviously before 2024, Netflix did not have live events. And then moving on to their risk analysis of Netflix. Obviously, I have the risk matrix graph here. Just going to touch on a couple of them. So obviously, member retention. Netflix is a subscriber-based business model, so members are essentially key to their survival as a business. And also, we've seen crackdowns in the last 4 years. These have kind of come with like mixed results. We see revenue shares kind of increase after those password crackdowns, but we also see kind of some negative reviews or negative like reputational stuff come from these password crackdowns. So it's kind of a mixed bag. Another big one obviously is competition and piracy. Streaming is an extremely competitive business currently, or industry currently. You have multiple different streaming models trying to undercut Netflix's price, take away some of that subscriber growth, take away some of the members. And then obviously piracy is also one thing to keep an eye on as well, just because online movies, TVs, illegally streaming games, these are all things that occur
in terms of like piracy, so we want to keep an eye on that as well. Moving on to their content commitments, these are just costs to either acquire pre-made content or produce content themselves. This is obviously highly variable, it depends on a lot of different things. And one thing I definitely want to touch on is the whole trade policy things with the current administration. I'd say about a week ago, Netflix was considered to be insulated from tariffs. Again, this is online streaming service, there's nothing really being imported or exported, so it had a really good reputation from investors in terms of how tariffs could impact Netflix. However, this past Monday, President Trump tweeted a 100% tariff on foreign-made movies. Now, what this means is still a little bit ambiguous. So are these, foreign movies coming into the US? Are these US produced, US initiated movies that have, scenes or parts shot overseas coming back to the US? We don't know what this means. We saw a bit of a dip in the stock price on Monday. However, since it has recovered to exactly what it was before that. So overall, the whole tariff policy and how it could impact Netflix is a little bit unclear, but it definitely shattered the illusion that Netflix or like streaming service in general could be, tariff proof or insulated from tariffs.
All right, so looking more into Netflix's financials. So we can see that Netflix has a PE ratio over the past 12 months of 44.07, which means that stock investors are willing to pay that premium to be investing in Netflix. But looking at their PEG ratio, especially over the past 12 months and compared to its competitors, we can see that it's overvalued. And from that, we can see that, from the book value, then we can see that it is at a 16.52. So investors are still willing to pay that premium to be involved in Netflix's stock and getting in on that stock price. And return on equity, so we're seeing that it's at a 48.84%, which is really impressive, especially compared to its competitors in this industry. And yeah, it's just outperforming all of its competitors and the industry and average by a lot. And then also looking at the return on assets, Netflix is using its assets really well. And we're just kind of wondering if Netflix can keep that up. And that's something to look at as investors. That's why we're kind of recommending the trim, along with the PEG ratio just being way higher than a 1. We kind of are seeing, can Netflix keep that value up over these next few years and meet those growth expectations that it has for itself. And then net profit margin at 23.25%. It is doing very well and making a lot of profit, and especially compared to its competitors. And looking at the debt to equity ratio, it isn't leveraging that much on its debt.
Yeah, so going into the debt, as Andrew said, the debt to equity ratio is 0.72, which means they have a balanced capital structure. Their total debt totals at 15.6 million, with most of it being comprised of long-term debt. It's actually 13.8 billion is long-term, which represents 88.4%. And then the short-term is 1.78 billion, and that represents 11.54%. As you can see from this graph, in the coming years in 2028 and 2029, they'll be on the hook for paying off $7 billion of debt then. So we feel very confident in them in the short term, and we still have confidence in them that they will be able to pay off in the long term, but they do have more coming up in the future. Breaking down the debt a little bit more, in 2024, they issued 1.8 billion in bonds. These bonds were 2 different types, a 10-year note and a 30-year note at varying interest rates, 4.9 and 5.4. And then the maturing debt in 2025, to break that down a little bit, it's 3 different types of, 3 different numbers for their interest rates. There's one at 5.88, one at 3, and one at 3.36. The one at 5.88 is a little bit more. It's at 800 million, which is a 300 million difference from the other 2. And now going into their free cash flow, we are very confident in Netflix's ability to pay off debts, to keep their free cash flow high, because of the huge spike of the increase in 2022 to 2023. It went up from 1.6 billion to 6.9, indicating that they have grown a lot and improved efficiency. And now breaking down the market share, Netflix has a pretty well dominant force in in streaming services. Amazon Prime is the only opponent or competitor that has roughly the same, which is it actually has a little bit more at 22%. But we believe that a lot of this Amazon Prime is because people want to get Amazon Prime for the shipping aspect. So while Amazon Prime comes along with the video, they just they can't really compete with everything that Netflix has streaming wise and now busting into live sports. Compared to Hulu, Disney Plus, and Paramount Plus, Netflix has done really well compared to those two. Disney Plus is the only one actually that has decreased in market share, going from 15 to 14.
So now we're gonna talk about the growth opportunities. As we stated before, they split up their sales revenue by region. So the first one is the United States and Canada. This is actually where Netflix is founded. The reason that I mention this is because it is a very highly penetrated market. However, the board did come out and say that they're still focused on making content for everyone. As we said before, live sports being one of them, as well as interactive games on there, just to capture the audience, the younger audience. This is where the largest shares of revenue come from. However, they have seen increased competition, but the ad-supported subscription has helped them with their growth. The next region that we're going to look at is Europe, Middle East, and Africa. This is a really unique region because Europe has some of the more developed countries, while the Middle East and Africa are still developing and still have some third world countries. This is actually where the most subscribers come from, with most of these coming out of Europe. Europe is limited in growth. Within the live sports market, this is because Peacock holds the right to the Premier League, the biggest soccer league in the world, which is based out of Europe. The Middle East and Africa do have high growth potential, but it is really dependent on how well they can industrialize and advance their internet capabilities. And then taking a look at Latin America and Asia Pacific, these two, as stated before, generated the least amount of revenues. Just as the Middle East and Africa, there's a lot of developing countries, and the internet capabilities are required for them to actually grow. Also, you will see high growth rates within these regions within previous years, and that's due to the low number of subscribers and revenues just based on numbers. So as you can see with these numbers, once they started splitting it up 7 years ago, this is their average change in subscriber growth year over year. And then we took these rates and multiplied them by the average subscription cost from 2024 to forecast out our 2025 through 2028 numbers. And then as you can see here, Europe, Middle East, and Africa, they are projected to eventually surpass the United States and Canada in revenue. But once again, it really is dependent on how fast they can develop as countries.
So now taking a look at the earnings per share estimates. So we have this baseline earnings per share that we calculated by taking the averages over the previous years and finding that Netflix, we do believe, can continue those averages and keep growing. So we had baseline earnings per share in 2028 around a 27.27, and that was an average of a 9% growth. And then the optimistic earnings per share, which we are optimistic about Netflix, at around 31.08 in 2028, and we got that by taking the 12% growth throughout the year. And then a pessimistic outlook on Netflix, we're still showing growth. As we said, we are still confident in Netflix and their ability to keep producing their earnings per share.
So now taking a look at our 1 year ahead price. For a baseline, you can see that we got a little over 1,200, and then for a free cash flow, we got about 1,363, and then we decided to keep them at 50% on each because we really didn't see a reason why to adjust that. Now Andrew's going to talk about the pessimistic and optimistic.
Yeah, so looking at these combined target prices, we do see the current price is at 1,138. And we do see that an optimistic around 1,325. And we are confident in that, looking at it with the weight of the 50% PE and the 50% discounted cash flow, we are confident that Netflix can reach that 1,325.
Now taking a look at the portfolio fit, Netflix does have a correlation with the fund of 0.61. Also, Netflix weighs 7.42% of the fund, which is why we also want to trim it just so it can match the market. As you can see, our communication services sector is about 6% higher than the S&P 500. So trimming it down by 10 shares would mitigate risk.
Now to summarize, we just feel that Netflix is overweighted inside the portfolio. This isn't necessarily a loss of confidence in Netflix, as it is a restructuring and diversification of Netflix's stock as a whole. Netflix still has multiple growth opportunities, as talked about by Evan, in developing countries and in developed countries with live sports and stuff like that. We just believe that Netflix has a high valuation, with their PE being 60% above the industry average, and their communication sector exposure as 6.2% higher than the market. So we do want to preface, this is a strategic rebalance, not a loss of faith necessarily in the Netflix stock.
All right, so thank you guys all for taking the time to watch our presentation. We all really appreciate it. And then now we're just gonna open the floor to any questions you guys have, and we'll be happy to dive deep into them.
Who's talking? You.
Yeah.
We're talking about the peg ratio.
Yeah.
No, I was gonna write down names or.
No, it's all right.
Direct this question to the front. Yeah. You said specifically that the PEG ratio was higher than 1.
Yeah.
Why is 1?
Why is one
Why
like
was that your number?
why is one the
Target, the bogey, the measured stick.
in all honesty, just looking on the internet, seeing that a 1 ratio is, if you're above or below that, there can be some risk, and that you can see that Netflix is overvalued or undervalued based on that PEG ratio. And when I calculated it over the past 12 months, I did see that it was at a 3.25, which I did think was pretty high. And I think that kind of relates back to the PE ratio also being pretty high compared to the industry average. And I mean, it is kind of hard because Netflix has grown so much over these past 12 months. So it is kind of hard to look at it in that aspect of being, okay, well, this is kind of risky based on the PEG ratio. But from calculating it, I was just like, okay, Netflix does seem like it's a little bit overvalued here. And that's why we were kind of thinking, okay, based off this PEG ratio, we are a little bit worried. Maybe we should trim back on Netflix a little bit.
I asked selfishly, because I don't know the right answer.
Okay.
We were also talking about that on fire, looking at the company and saying, all right, it's somewhere in the 1 to 2 range.
That's what I was saying.
It's over 2, it starts a little stretched.
Yeah.
Because you can say the PE is high, but we're getting growth for that.
Yeah.
Well, then when you adjust for growth, it still looks a little expensive.
Yeah.
So, that was good. And then. Talking about, sorry, are they gonna be able to pay after that? This is more of a comment. You don't have to pay after that, you just have to be able to refinance it. So we can roll that. So as long as the cash flow is there to pay the interest.
Okay.
And it's a solid credit, so we'll be able to refinance.
Yeah.
Probably not a huge concern. And just had that conversation in the hallway, so we probably should be a little more concerned about. Slide 16. So that's the actual number of subscribers versus the dollars. Yes, okay, yes.
And I apologize, I use these as the growth rate. I actually multiplied it by the 2024 revenue. I didn't use it by average cost of subscription.
Okay,
So that's how I forecast it out from 2025 through 2020.
so your
But
growth is gonna be a function of
Of
this
subscribers, all I use.
plus increase in price. So if your number of subscribers grows by 5.7 and you charge everybody 1% more, the actual growth rate is more than 5.7.
Yes, it would be, that, I just use subscriber growth, but.
That is subscriber.
Yes.
Help me understand that. I had that written down in the question I want to ask. So say that again, in terms of how you projected out revenue growth of the segments.
So they started splitting it into regions like 7 years ago. So I took the change year after year, and I took that average change, but I used straight up subscribers. I didn't do anything with revenue, just pure subscribers. And then I used that as my like growth rate to forecast out. So I took like 2024's revenue, and then we'll just use the US and Canada as an example. So it was 5.6 or 5.68%, times their, plus one times their revenue of 2024 to 2025.
Got it. Follow-up question then. Do they have different revenues from the different sources, the different regions? Do they charge different?
Yes, they
They
do,
do.
they do.
But it was all in US dollars is the one that like, I'm like, you took it off there, like,
And then on slide 17, you convert. Maybe it's 18. Yeah, so going from 17 to 18, for 17, you have the revenues by segment, and then you are saying, based on this, here's the earnings. So are you applying the same margin rate on all regions?
yeah, we didn't have something where we could, I guess necessarily segment it by region for earnings per
Do
share.
you know if it's roughly the same? Are they more profitable in the US or is it?
Well, the US is, that's the most, I mean, that's where most revenue comes from. I'm not exactly sure off the top of my head what the net income is looking like.
You feel like this is an appropriate way to measure earnings per share in the future? Just taking the revenues individually with different growth rates and applying the same margin across the board?
Well, I believe for this, we use 27%, because we use, their Q1 earnings just came out. And that's, I believe, what we ended up using that profit. Just for,
I guess what I'm getting at is that, if say the US is the largest, so maybe they have the slowest revenue growth rate, but they have the highest margin. So the margin as a whole, company is gonna be impacted by the US, being the highest revenue. But if another segment's growing faster, that's gonna maybe increase your overall company's revenue growth rate. But if their margin is relatively small, and you're using the company's margin, you may be overstating the impact of earnings of that higher growing segment at a lower margin. That was the reason for the question. It sounded like you had the ability to find those individual margins.
that's correct.
Thank you.
Perfection. Is there any commentary on live sports in terms of profit margin versus original content or purchase content? Is there a cheaper source? If you're expanding into the live sports, is that gonna be a more profitable, higher margin business, or?
I mean, I'd say so, just because, especially if they decide to do contracts, like for example, with the NFL games, that was just a one-time thing. There's definitely people that it's not released to the public. But it was the highest streamed NFL games ever on Christmas Day. So if a contract was put in place, I mean, I definitely think that.
They rarely mention. You guys didn't really talk much about tier.
I kind of touched on that at the beginning. I just kind of explained that in 2024, they introduced the ad support model, which is like $6.99. And then that's like less than half of their standard model of $15.99. And then like less than a third of their like premium model of $22.99. And that's all in USD that I did that.
Yeah, so. It would have been interesting to see.
Yeah.
Like, how that's changed since they've launched it, to see if it's being, what's the term I'm looking for? Cannibalizing, thank you. If it's cannibalizing, like, as it's cannibalizing kind of to. Well, yes, that we can add
Right, that was some feedback we got initially, was to kind of like look especially at their ad supported model and see kind of how their revenue figures are going there, so their subscribers. I think we tried to look at that as a team and we couldn't really find those exact figures to where we could see, okay, ad supported revenue, like subscriber growth, subscriber share, like And maybe is there some correlation here because we're seeing the premium decline, but we're seeing the ad revenue rise, like would that be, I guess that's a good question I'll ask, so yeah, but we could not find that.
I was thinking that, state of consumer. Switched. College.
Right, so it's kind of years. Yeah, I mean, if a recession does end up obviously coming, obviously some experts say it will, some say it won't. From our analysis, we do find Netflix is like a kind of like a core product, almost similar to like cable TV back in like the 2008 recession. Where, okay, let's say how many households are just cutting cable in 2008, maybe not as high as like opposed to like cutting back on like going out to dinner, going out to the movies, like, I don't know, buying new video games or something like that. So we believe that Netflix is a core product where like cuts in terms of discretionary spending would like be reducing those areas I just mentioned. But maybe not so much in Netflix because it's something you can enjoy at home. It's an entertainment service and it basically you have unlimited access to it and you just pay a monthly fee. So obviously in terms of that, you could even maybe see some, I wouldn't be so sure in terms of growth, but a more positive outlook compared to like other, you know, industries, other companies as well. And I think that's definitely reflected in the investor segment. You see the stock price kind of rise to these like, even like after the tariff announcement, and it didn't dip as much as other companies did. And I think investors are confident that even in a recession, that it's still going to stay pretty strong worldwide. So
I'll say it's good people did that, but I think there's a difference. If you've ever tried to cancel cable versus canceling a streaming service, one is a lot easier to do than the other. So. Cancel the stream, when you try to cancel cable, you're on the phone for like an hour before you can find it.
Guess what your debt slide?
all right, sorry,
Your debt slide.
yeah, was it, you want to look at the this one?
Yeah.
Yeah, so if their free cash flow, this is more of a curiosity question, was 6.92 billion in 2024. Why did they issue new debt of 1.8 billion? If they've got cash flow that well supports them having to issue bonds, did they, I mean, any reason for that, why they issued debt when their cash flow is 3 times that, 4 times that?
I honestly couldn't tell you. I do not know, so I don't want to.
I mean, I don't know either, but I just remember seeing that, I was like, why would they
could have
borrow money?
roll over.
Use that
maybe
roll
that-
it, Yeah.
Yeah,
If it's newly issued, but it's just maturing. Or they think 4 or 5% is competitive and they can get a higher return with that cash.
Or they repurchase $5.4 billion or something. Oh, there you go. That probably, better than, yeah. But why would you do that if your valuation is 40% higher than the industry average? I'm paying attention. Why would you? And by the way, is that, which reminds me, is that a good? Meaning, you're comparing your valuation to.
I think so, yeah, but then it's also kind of hard because Netflix is just a pure streaming business compared to, I guess it compares better with Comcast compared to like something like Walt Disney Company, where they have many different sectors of revenue. It's not just based on their streaming. So I think, yeah, it is a good comparison, more so with Comcast over Walt Disney.
Right, I think what Andrew was saying too, I think Netflix is, obviously they're in the communication service industry, but I think they're pretty unique just in terms of, like Andrew said, they're streaming only. I mean, Walt Disney, obviously they have a ton of different business lines and they're combined with Hulu, ESPN. Comcast is NBC, Paramount, CBS, HBO Max still does some stuff on cable too, so I think Netflix is kind of one of one in terms of just overall being a streaming exclusive company compared to their competitors.
When I saw that, I couldn't stop thinking, because where I was going with that, you know, valuation against its history and its growth. It's a different one. So it'd be like, you know, people talk about Tesla, is a great car company, it's a technology. Great valuation to Ford and GM. It's like, oh, it's better than all three combined. So, you know, thinking about the relative valuation to itself, yeah, it's over value versus peers, but as you just said, maybe that's not a good. Some of those, but how does it compare to itself? Listen to projections moving forward into the street. So that's another way. These kind of things is they're like working in projects or buying and selling their stocks. Everyone's relative valuation. It's a full he was at 35 years ago, and now it's at 40. Well, maybe it's come faster. It's got more stable income. Rationale for that. Most of them. Hence it's
You can ask what the tariffs?
they talked about big one for like 20 minutes. Yeah. You just have to wait.
No, like, tell me tonight.
Yeah.
I really want tariffs.
Everyone's coming out here today and listening to our presentation on our company, ASML, and our evaluation, which we've done over the last 4 months. My name is Ted Wenzel.
I'm Kaden.
I'm Brecken. I'm Grant. I'm Stan. So today we're going to talk obviously about ASML, but we're going to give a little overview of ASML and what they do. Their business overview, their two main revenue streams, and break down those two. Then dive into the risks associated with the company. Then we're going to talk about the key financials that we found were important and that we used in our evaluation of the company. Like I said, the two key growth drivers, the EV lithography machine, which we'll get into later, and the service and field operations on those machines. Then we're going to talk about the portfolio fit and how it fits in the Spellman Fund and our recommendation moving forward with the company.
A little bit about ASML, just a quick overview. They are a lithography company that's headquartered in the Netherlands. They have two primary drivers for their revenue. First being their extreme ultraviolet machine sales. Basically, these are giant machines that print circuits onto silicon wafers used for computer chips. And the second way is servicing these machines. These machines are about 1,500 to 1,000 pieces, huge machines that have all these different moving parts, and ASML has the only technicians in the world that can work on these machines. Therefore, every machine that they sell, they get revenue from servicing them, fixing them, upgrading them. And then the important thing to remember about EUV machines is that ASML is the only company in the world that manufactures these. Every other lithography company in the world does deep ultraviolet. The advantage of these EUV machines is they print their circuits smaller than everybody else, which allows for more transistors on the machine, therefore making these computer chips more effective and more efficient, which is extremely important for the growing demand in computer chips. Using AI technology, smartphones, electric cars, having effective and efficient computer chips is super important, and they're essential to technology.
All right, next, the ASML overview. We are proposing a limit buy for the ASML stock. Why a limit buy? ASML holds a monopoly in the EUV space currently, and they dominate the lithography market with 80 to 90% market share. And currently there's a surging demand for semiconductors driven by AI, EV, and cloud computing. ASML, we are proposing 15 shares purchased at a limit buy of $662. This will make up about $10,000 in value and 2.5% of the Spellman portfolio. The current value of ASML is $706. Our target value is $845 with a return of 36% found using our free cash flow and PE method. The outlook for ASML, we have a potential challenge of the US and China trade tensions with tariffs. However, one of the opportunities with ASML is the expanding market for the EUV. Our key driver is the capital expenditures for semiconductor manufacturers such as Taiwan Semiconductor Company, Intel, Samsung, all driving the EUV sales up for ASML. And lastly, one of our risks is the potential interference with biomaterials that's currently in the portfolio. They're both in the semiconductor industry, however, they're along different stages through the supply chain, which they could potentially look at.
And then getting into a few key statistics, you see over the past 3 years, PE has been pretty steady around that 35 mark and looks to fall this year. Also with ROE, it's been really high, especially compared to the industry average. ROE for ASML has been very high, but also looks to fall. This can be contributed to lower than expected sales for ASML. In 2024, US and China trade tensions basically limited the amount of EUV machines ASML could sell to China. China is their biggest customer, roughly a third of their sales go to China. So this was a huge hit to ASML's financials and caused that big fall. However, despite that, EPS has been able to rise. You can see their stock, there's a 5-year stock graph there on the bottom of the slide. And it's been very volatile in the last 5 years, but does seem to be trending upward. And here is the Sankey diagram, just a quick overview of ASML's cash flow. On the left side, you can see the two primary drivers that we described, sales and service. And they have a huge cost of revenue. Roughly half their revenue is going to that cost of revenue, which is pretty expected for this company because of these large machines and the cost that it takes. But ASML has been able to achieve a pretty substantial net profit. Now looking at their past revenue streams, over the last 5 years, ASML has done very well. They've had really steady growth. However, like I talked about before, in 2024, their sales did dip. But I'd like to point out that their service revenue did not. This really speaks to the fact that whenever ASML sells a machine, they can service it, upgrade it, fix it. So it decreases the volatility of their revenue over the years. Whenever they have a bad year, they can kind of insert that revenue that they get from service to decrease the loss for that year. And then on the bottom is the other, which is made up of a few different ways ASML gets revenue. First being the DUV machines, which is their basically last year's technology. They sell spare parts to the machines. They license that technology. And then a subsidiary company that ASML bought called Metrology. They work more on the computer chip side and refining and troubleshooting that process. And then for their future revenue streams, we project strong revenue streams, strong growth. Like I touched on before with the tariff negotiations, they really took a big hit to their sales in 2024. However, in recent news, China has been willing to negotiate with the United States on decreasing these tariffs and these trade restrictions. Since they had that quick response, we don't think that it's going to be a big problem in the future because they're so willing to negotiate and how essential these EUV machines are. We don't think it's going to be that big of a problem. And with the huge rise in demand for computer chips, we think that there's going to be strong revenue growth in the future for ASML.
Diving into the risks associated with ASML, like any good company, they always have their risks, regardless if it's internal or external. Here on the right, we have a matrix of ASML's risk with the significance of the risk and the probability of said risk occurring. We have a high significance and high probability of supply chain disruptions. Like we discussed, ASML is a multinational company. They operate in countries outside of just Amsterdam where they're located, which means they are dealing with any kind of disruption in the supply chain of any of those countries. So that's why exactly we have it in the high significance and probability category. Then we're going to move to high significance and medium probability, in which we have a regulatory and legal risk, market demand fluctuations, and intellectual property theft. With the regulatory and legal risk, every company has different legalities and different regulations. So ASML then has to devise a business plan how to get either around that, because they're not going to be the same in any of the countries that they operate. With market demand fluctuations, ASML is in the semiconductor industry, which means they're in a very cyclical market. So they deal with any kind of fluctuations that arise for companies in said market. Lastly, with the intellectual property theft, that's pretty simple with IP theft. Secrets from the company can be taken and given to different companies that are going against ASML, which is why it's quite a high significance, but it doesn't happen as often as some may think. The medium significance and high probability is a forex rate volatility and tech and innovation competition. With forex rate volatility, ASML, like I said, operates in multiple different countries, therefore they're dealing with different currencies, and any foreign exchange rate volatility is going to directly affect ASML.
And in tech and innovative competition, every company has competitors. For example, ASML with Nikon and Canon. Anytime they're making a leap in how they're going about their business, for better or for worse, and the ASML needs to be prepared for how they're going to react to that. Lastly, with our medium significance and probability is our environmental and climate risk. That kind of goes with just transportation, how they operate, and they deal with any kind of legalities regarding environmental issues and climate risk.
Next, we're gonna be looking at the financial ratios for past years and comparisons with our two main competitors and the industry average for 2024. First, with the PE ratio, we can see that we've had a pretty steady PE in the past. Our trailing 12 months has fallen, so we think it's a great time to buy in right now. With the higher growth expectations and market position being pretty steady, along with our PB as well. Next, looking at the ROE, ROA, and net profit margin, we can see that our 2024 ratios have been higher than the industry average and competitors. This is showing pretty efficient management and strong profitability for ASML. And lastly, our debt to equity ratio in 2024 is lower than the industry average, showing that ASML uses less debt financing and there's lower financial risk.
And so going off that lower debt to equity ratio, ASML's really been kind of trimming some of their debt. For their debt structure, you can see that's made primarily of senior unsecured notes with one small mortgage term loan. And they're all issued at relatively low coupon rates that ASML really took advantage of in the early 2020s. So their cost of that is quite low. And they've been lowering the amounts, as I said, with the most recent debt issued at only $500 million compared to some of the $1 billion debt that they issued earlier in 2023. So over the next 3 years, they're going to have $2.8 billion maturing. However, with their current cash and current assets, they'll easily be able to handle that obligation.
We're looking at the first revenue stream for ASML. We're looking at the extreme ultraviolet sales, or EUV for short. What is the EUV lithography technology? As Sam discussed earlier, they print onto little silicone chips for these microchips that are very common in AI and all the new technology we see now today. So there's a major great growth opportunity for ASML because it's very essential for the next gen chip processors and the patterns there. It's indispensable for leading chip makers, as if they want to stay ahead in this leading AI race, they're going to need these lithography machines in order to help produce these chips. This then gives ASML a near monopoly when it comes to EUV technology and commands premium pricing as well as long-term contracts because, like we said before, nobody else is making these machines. Therefore, we want to lock in a long-term contract with the company. With that market position, there's always going to be demand drivers. For example, there's a huge surge in demand for powerful and efficient chips. Think AI, think your HPC chips. And AI technology, obviously having smaller and more powerful chips, the demand for that is going to obviously increase. There's an increased demand in certain sectors such as healthcare, automotive, and financials, just to name a few. Extreme ultraviolet is kind of a family of machines. It's not just one machine itself. So with ASML's technological leadership, they're going to be transitioning to the high NA EUV streams, which is numerical aperture. These chips are smaller and more effective, and they can process more than just the traditional ones. And they're going to be with a strong revenue growth moving forward, with technological leadership improving over the next decade. It's obviously very critical for chip makers to meet AI and cutting edge technology application demands. Lastly, the competitive advantage that ASML derives from these EUV sales. Like we said, a very unique opportunity in the semiconductor industry. With that being said, there's a huge demand from these leading chip makers, and ASML has a substantial market share with the high NA.
So diving into some of the numbers from the EUV sales, over the last 5 years, ASML has seen 27% revenue growth year-over-year for the EUV, and assuming that there's continued growth in the semiconductor industry with the increased demand for things like quantum computing, AI, EVs, pretty much anything that's computerized needs these chips. So we think that 27% growth is very achievable for the company moving forward. On the bottom of the screen, we have projected revenue for the next 5 years. As you can see, by 2029, ASML is projected to bring in just under $27 billion in revenue from EUV sales alone. Then here's a couple different outlook scenarios for the growth of the UV sales. A couple things to keep in mind here. Both of these outlooks are assuming a net profit margin of 26.8%, which is what the company's doing right now, along with shares outstanding remaining the same at 393 billion. So starting with our pessimistic scenario, we chose 15% growth, which is just over half of what they're doing right now. And we want to go with a lower number here because with AI and quantum computing being fairly new technological advances, we think that there's a decent chance for them to be regulated or restricted, which may cause a decrease in demand for these chips. And so with that 15% growth over the next 5 years, by 2029, the EV should account for $11.38 earnings per share. Looking at the optimistic scenario, we went with 30% growth, which is not much higher than what they're doing right now, but we believe that being able to achieve 30% revenue growth year over year is quite the optimistic outlook for the company. And by 2029, with that 30% growth, the EV earnings per share should be $21.02.
All right, for our second growth driver, we identified service and field operations, which, as Sam touched upon, it's supporting their lithography system at customer sites globally. The installation, maintenance, training, and troubleshooting, as well as a big part of that is upgrading, where they're taking old units and then customers are paying to have them upgraded into more efficient and more capable newer units. And so performance and uptime of these lithography machines is crucial for customers, and they're going to work with ASML to ensure that they have service. And this drives revenue for each unit sold throughout the globe. It proportionally increases revenue through recurring revenue streams. As well, ASML is the sole provider of support. In other industries where you might be able to contract support from external competitors, ASML is the only one that services EVs. So customers are going to be going to them for support. In the graph, you can see the total net sales based on end use, where logic and memory just makes up the end use of their units like EUV and DUV, and then installed base management, which is the service and field operations. You can see that they've had steady and consistent growth over the last couple of years, with Q1 2025 looking to be on pace for the year. So assuming that sales of lithography machines maintain their growth, as well as the semiconductor industry in general maintains demand, we are projecting that service and field operations has a 17% average growth rate based on the past 6 years of revenue. But one interesting thing to note is that even if units of new lithography machines do not remain at their current growth rate, we're projecting that service and field should remain steady. So by 2029, we'll have 14 billion in service revenue and around 10 for service EPS. Again, assuming net profit margin remains around 26.8% and 393 million shares outstanding. For our pessimistic, we're looking at around 9% growth with revenue of 10 billion and EPS of 6.2 by 2029. And as for optimistic, we're looking at 25% growth with revenue of around 20 billion and EPS of 13.5 for 2029.
So here's a breakdown of the earnings per share for each revenue stream of ASML. For 2024, you can see that the other sales, which includes the DUV, spare parts, or licensing, is the main driver for earnings per share with $9.21. EUV in a close, or not really close second, but second with $5.66. But as technology increases and the demand for these EUV chips increases, we should see a EUV EPS rise significantly, and by 2029, it will be the main driver for earnings per share with $18.40. Other sales still producing good EPS with $15.49, and service that steady growth bringing us to $9.76 for a total of $43.65 earnings per share. Then here's a comparison with those baseline EPS along with a optimistic outlook and a pessimistic outlook. If we're looking optimistically at the future for the 25% growth rate, ASML should see 58.9 earnings per share. Or looking at it pessimistically with 10% growth, we could be seeing 31.1 earnings per share.
As for our valuations, under the PE method, we estimated a 1-year ahead PE of 27. And then 1-year ahead EPS of 22.7 for the baseline, 21.2 for the pessimistic, and 24.1 for the optimistic. Giving us 1-year ahead price estimates of 721 for our baseline, 632 for our pessimistic, and 815 for our optimistic. As for the discounted cash flow, we have average values of 637 baseline, 452 for pessimistic, and 858 for optimistic. We weighted our combined target price at 30% PE and 70% discounted cash flow because we believed the cash flows had a more accurate valuation than PE. So for our overall target price, we have a baseline of 662, pessimistic of 505, and optimistic of 845. Our current price is 706.22, and while we're quite optimistic about this stock, we believe the more risk-averse option would be to implement a limit buy at the baseline of 662.
Now, before we open up the floor for questions, we're gonna talk a little bit about how ASML would fit into the Spellman Fund. As you can tell, ASML is a quite high correlation coefficient to the fund at 0.76. While that may be a little misleading, as we understand the Spellman Fund is heavily chock full of semiconductors and technological companies, we are still very confident in ASML as a valuable investment and for future potential revenue growth and technological leadership in the years coming. Our suggestion here is a limit buy at $662. 15 shares would equate to about $10,250 in market value and hold a weight of 2.5% in the Spellman Fund. We understand that there is a little bit of cash in the Spellman Fund, but in order to counteract our purchase, we're selling 67 shares of Applied Material, which has a very high correlation coefficient to ASML, as they are similar in what they do, which would be lowering Applied Materials weight to 2.65 from the 4.6 it is at currently. So an overall summary of what we've described today, ASML as a company, we talked about the revenue drivers with the UV lithography machines, the chip market potential, obviously the sales and service that goes hand in hand with those. Then we talked about a little bit of the risks that ASML faces as a company, for example, supply chain disruptions and tariff and trade war that's currently ongoing. Then we did describe our evaluation of the company and how we thought our free cash flow method would look for ASML as a whole. Then we talked about the correlation and the portfolio fit in the Spellman Fund. And before we go, we're going to talk about how we are suggesting a limit buy at $662, which would be 15 shares and hold about a 2.5% weight in the fund, and selling 67 shares of Applied Materials, which would reduce their weight to 2.65%. Thank you very much.
Have they lost any type of market share in the last 2 years to the competitors, to these people?
I can answer that. As far as Canon, and I think it's Nikon, they operate in the DUV, which they do have like a split market for that lithography machine, but currently no other company is manufacturing and selling the high nav EUV machines.
And is there any competition in sight that might do that?
Probably not for around like the next 10 years at least.
There's been talks of like companies in China that have supposedly been creating EUV, but there's nothing that's really been confirmed. There's been talks about this for a few years now, so it's very speculative. It's not solid.
Things is something is 25 years ago, there's nothing called Intel that was untouchable. Their R&D was higher than the next competitors, gross revenues. That competitors sound bigger. Yeah, so it does kind of have to look over your shoulder a little bit. And that's why I was asking. Who are their top 5 customers? You that discussed, is that available or are they?
It is available.
I heard Taiwan Semiconductor.
Yeah, so Samsung, Taiwan Semiconductors, that we have listed. Intel, and then yes.
Did we take a look at their CapEx budgets for the next couple of years? When you look at the growth projections, something with the, all right, who's buying their stuff, and how much are they investing in these large capital projects? These seem like, I'm guessing, fairly expensive to begin with. So you probably see that including capital budgets with Samsung Technologies said we're increasing CapEx by 15% next year. Kind of look at how you benefit from that. Just a thought. Page 8. Your average growth rates. Is that a compound annual growth rate, or did we just take that divided by 5 or?
No, that's just divided by 5, but I think looking at the CAGR, it was about similar.
Okay. And then page 11. The other groups also showed us a PEG ratio. Any reason you left that off here? We have interesting car conversations in the way. So 3 hours to chat. Mostly it's nonsensical bullshit, but sometimes we actually talk about this. PEG adjusts for the growth rates. If I'm looking at two companies, I'm saying, oh, this one's expensive, we look at PE, and this one's cheaper, looking at PE. Usually it's a reflection of the growth rate difference. So I was curious when you're looking at this compared to Applied Materials, Nikon, or somebody else, are they growing faster or are they growing slower? Is that why their PE ratio might be slightly higher than Applied Materials or higher than Nikon? Do you know that? You know how the growth rate compares? I can't remember off the top of my head. That would be an important differentiator between the two. It looks like this one's growing at about, for the last 5 years, 24%. And projections are probably a little less, but they also always seem to surprise the upside, so we can look at probably another 20%. So I just wanted to know how that compared, because I don't think growth rates are as high for Nikon and Applied Materials.
Okay, I have a question about tariffs. One man, one trick pony. Can you help me understand how I would think about tariffs with this company? Tariffs and / industrial policy and geopolitical risk. Is that a plus for this company or negative?
For ASML, it's probably a negative because they side with the US in trade negotiations and China is their biggest customer. They don't want China to have this technology basically. So right now, I would say it's a negative.
The Dutch company. Okay.
Yeah.
So right now, we have tariffs on the Netherlands, right? Are these guys, is their products exempt or not?
They are.
For the moment.
For the moment.
Okay, why?
I would assume it's
Get
basically.
the older students later.
I would assume it's like a technology that the US wants as well, so they don't want to tariff it.
Okay. For the foreign company, do we have any domestic equivalents of this, right? These are the DUV. I mean,
We do, yeah, there are like,
domestic producers.
they produce in California and
guys.
they do. They produce in California and North Carolina, I believe.
Okay.
Which of course is good, but there aren't any other companies like I said before that do
Right.
the EUV. So we would have access to DUV, but they do produce in California.
Okay, and about 40% of their sales are China.
Yeah, they're,
Okay. So, and we don't want them to sell to China.
Yeah.
Right,
at the moment, yes.
at the moment. So you think that that's gonna change?
We thought so because I think it was on Monday that China came to the US, they were trying to negotiate something. Obviously, nothing solid, but
What did NVIDIA just do? Right, I mean, like, aren't they asking for to be able to sell their chips globally now, right? So to be sort of exempt from some of these, the Biden Protect the Chips Act, right, to try to protect our security. So you're listening to All In podcast? David, you know that? Do you? Oh. It'll make you vomit. But these guys talk about like chip manufacturer, protected. I just can't figure out like which half the time they're tariffing the inputs, but then they're trying to like not tariff the inputs and protect them, but then trying to prevent us from exporting, and like, it's just sort of not clear that they have any clue as to how to do industrial policy with that. So I mean, like, it makes it, my point is like, you know, you're like assuming, I heard the word, someone said, we're gonna assume this growth rate. You know, the old famous economist joke, right? Like, yeah, I'm gonna get it wrong, but basically, you know, they're on a desert island, and what would you do to try to survive this desert island, and you've got a can of food, and someone's like, I take a stone and break it open, and someone else said something else, the economist says, I'd assume a can opener. Kills most economists, by the way. The point is like, you're assuming the most important thing at the moment, like, I don't know how you figure it out, there's so much uncertainty about what's going on. Their sales are down 25%, their stock was at 1,000 12 months ago. And you're talking about like, ooh, limit buying 600, like, why did it fall so much? Right, like, why did it fall 25% sales?
Well, I think it's just the uncertainty like you're talking about.
Okay, but do you see that going away?
We think it's gonna be a priority for China because of how essential this is. So it may or may not, I don't know.
Yeah,
Nobody knows, but
I
we
guess
think they're
I
gonna
mean,
make it a priority.
you're burying the lead when you say, we're gonna assume this, like, you know what I mean? Like, that's where all the action is at the moment. Is in that assumption of sort of growth. These aren't normal times. It's not clear anybody has a clue as to what's sort of happening. And for them to have 25% taken off of the value of the stock, I think we should make you start concluding error bounds around all of these estimates rather than just sort of pessimistic and optimistic. But I'll stop torching you. And saying tariffs. Right. You got a blank folder, please?
Yeah, no, my point was when I pulled it up, it didn't look like they were in US revenues, which is why you wouldn't be affected by tariffs. So if you're a Dutch company selling to China, Korea, and Taiwan.
Okay.
With US tariffs being imposed on those don't matter. So until the end product comes back. But that doesn't.
But I mean, like, if we don't sell as many end products, right? Because of tariffs, then you don't need the input products. But I also don't understand, someone said something about tariffs in 2024. And I didn't understand sort of in that affecting China. I mean, like, there was pressure by the Biden administration on them not to sell the tech to China. Is that what you're talking about?
Yeah, I mean, they've been limited with how many they can sell.
By who?
Yeah, export restrictions.
Yeah, but who put those export restrictions
The
on?
US.
From the manufacturing that they're doing here?
They're doing, yeah, I mean, they're doing
Okay.
manufacturing here and.
Yeah.
Yeah, but, yeah, that's.
So that's what took the top off their sales. Is by our government saying you can't sell them.
Yeah.
Okay. The government, we know what our government's gonna say next week about this company?
I mean, nobody really.
Okay, then.
Yeah.
How does our government spell one company do? I was trying to figure out. They're very.
It's a Dutch holding company, but it's a US patent.
What is that? How is this impact green?
US also because it comes from money.
Yeah.
Right.
Then we have questions before.
I thought you were gonna go to page 21.
Probably, was page 21. Might be the one. I do have a question on that. Yeah, I was asked this one. How about the philosophy on how you came up with 70%, 30% split between PCF and
So I believe they had a fairly high PE from really like prosperous years in 2023 and 2024. And so like I said, we thought the free cash flow would just be more accurate than having inflated PE. So we weighted it more to free cash flow.
Earlier, one of the board members asked about the PEG ratio. Great question.
it was an older, much older.
Very old. He looks older than he actually is, believe it or not. And you talk about having a higher PE reflective of a higher growth. So if I'm looking at an optimistic and a pessimistic scenario, in a pessimistic scenario,
earnings are only growing to 21.2. That's a slower growth rate. Optimistic 24.1, a faster growth rate. Yet we assign the same price and earning multiple in both of those scenarios. That one, yeah, this thing. Sure. What would perhaps, doesn't have to be exact, there's no science behind this. What would be maybe a better pessimistic, optimistic?
Yeah, I guess pessimistic, because the 12th trailing month is right around 27, so that's why we use that for the baseline in all three of them. So I guess pessimistic could be kind of more like 25 or 24, but we haven't seen that in the last like 5 years with this stock, so I highly doubt it would go that low. As for optimistic, in 2024, it was I think 35 or around in the 30s, so that'd be a better optimistic estimate.
That was from previous, some can hire, some people, yeah, because I would look at that and say, earnings are slowing, that's our pessimistic view. The market is not gonna pay as much for that dollar of earnings today, that slower expected growth rate. Conversely, they would pay more, we expect to accelerate. Just one last good point, if you go to the optimistic, pessimistic, and the other tables and all that. Next one. I'll take some. Okay, quick story. So last week we had our chief investment officer guy come say and does a presentation in Madison and one. He's doing it in a room like this size, it's packed full of people with the screen up here. He's giving his presentation with a slide deck that you'd be sitting in front of, like it's like he's having a discussion or it's in. So if you imagine you're sitting, I don't know, where the coffee machine is, and you're looking at the screen up here, and you get Nick's eyes that don't work as well as they used to. How do you think they would do looking at that screen?
Yeah, I'm kind of seeing the same thing too. Because I'm looking at that, it's hard to see.
All right, so quickly, life lesson: don't try to jam this and a couple other ones too. Because you put way too much stuff in one slide. Separate it up into separate slides, make it bigger, and really focus on the things that we do. So now, when we're doing this kind of presentations, people can really understand. And even from here to here, with these eyes instead of struggling. So, do one slide with a pessimistic, make it. That's just kind of something to. Good job.
Thanks. I did have a question. You guys talked a lot about the service contracts, and I'm gonna make it fast because we're running late. How long are the service contracts on average? So it may roll off, right? And then they may not have the recurring revenue. So if sales of the new machines have declined, and you guys said at one point, hey, don't worry, look at the service contracts, there was really no decline there. You sell a machine, the service contract comes in place like a year later, and it's a 2 or 3 year contract, let's say. Service contracts can actually be a lagging number then, right? So if we saw sales drop this year, it could be in 2 or 3 years, you see a drop in service contracts, because there's like machines to sell the contracts to, or, the other existing contracts roll off. So just, I keep that in mind a little bit too. It's not a guarantee that the service contracts will just flatline or always be steady or recurring revenue.
I'm smart. Thank you.
Thank you for joining us for a stock valuation presentation on JP Morgan Chase. My name is Ben. I'm Sam.
I'm Sean.
Noah. Hey.
So just going over a brief outline of what we'll talk about in today's presentation. We'll start off with a business overview of who JP Morgan is and what they do. And then we'll get into the revenue breakdown. What sources of revenue do they have? And then we'll talk about some potential risks that JP Morgan face. And then we'll look at their overall financials and some key growth drivers that we identified, which are private credit expansion and assets under management. And then we'll look at the valuation portion of the presentation and how it fits into the Spellman Fund, and then give our recommendation. So JP Morgan Chase is a leading global financial institution. They have over $4 trillion in assets and operate in over 100 different countries. They have been recognized as a top U.S. bank across investment, commercial, and other different market segments. Their primary revenue streams come from lending, investment, and fees. And to break these down a little bit further, their lending revenue comes from commercial and consumer loans. Their investment revenue comes from asset management and trading gains, and the fees comes from investment banking, advisory, and net interest income. So we are recommending a hold on JP Morgan right now, as their current weight is 7.65% in the fund. And this number is as of yesterday. It might have changed a little bit today. They've been a top performer in the financial sector over the past 5 years, and we found a lot of growth opportunities for them that provide a stable outlook, and we think that they have potential to remain one of the top consistent financial sector. So as I said on the last slide, our recommendation is to hold our current shares of JP Morgan at 7.65%, and their current value in the fund, this is also as of yesterday, is $31,856. Our overall target price is $268.12. Their current price, and this is also as of yesterday, was $254.50, and this gives us a return of 5.4%. And then our target valuation in the fund after it hits the target price would be $33,515. So as a business, JP Morgan faces opportunities and challenges. Some opportunities that they have is to expand their presence in some emerging markets and also implement digital transformation with AI. Some challenges that they might face are economic uncertainty and market volatility, and also that the banking system is very competitive platform. Some key growth drivers that we identified include private credit expansion and growing asset and wealth management. And some potential risks that JP Morgan might face are rising loan defaults and charge-offs, and these usually come with an economic downturn. Also, their credit costs rose to $3.3 billion in Q1 2025, and this is up around $700 million from Q4 2024. Another potential risk that they may face is potential changes in interest rates. So as of Wednesday, interest rates stayed the same at around 4.5%, and there's still no cut expected in June. We'll also get into this later in the presentation. So next, I'll pass it off to Noah, who will talk about their stock return.
Okay, so taking a look at returns, 5-year cumulative return for JP Morgan was 215.05%, while the US major banks index was only 149.03. So JP Morgan has been a strong performer within the financial sector, providing good returns as well as dividends. And taking a look at the financial sector weight, so within the fund it is currently around 12.17%, and in the S&P 500 it is 15.93. And then the 52-week range has been relatively stable, besides obviously the tariff movements. And then taking a look at the key statistics, you can see that they've had good increases in ROE and some very significant growth in their EPS over the past 3 years. And then taking a look at PE and PB has only risen slightly. All right, so then taking a look at the revenue streams. So the two main revenue streams are consumer and community banking at about 40% of total revenue, and commercial and investment banking at 39%. And then asset and wealth management is 12% and corporate is 9%. And taking a look at that graph, you can see they've had pretty steady growth in the revenue over the past 4 years. And then you can see that big jump from 2022 to 2023 was because they acquired First Republic Bank, and that generated a lot of revenue for the company. And then these charts show the revenue streams for 2024 and 2023. And then again, you can just see that consumer and community banking and commercial and investment banking are their two big segments, and the other two not quite as large.
Taking a look at the matrix on the right, you can see that we were able to identify several risks that JP Morgan might face, but we only wanted to go over 3 of the major ones that we thought had the most impact on JP Morgan. The first being credit risk, and this is when borrowers fail to meet their contractual agreements to pay back capital they borrow from JP Morgan. And this can occur in loans, derivatives, and guarantees, which are products that JP Morgan Chase offers. The next risk is cybersecurity, and cybersecurity results in a monetary loss, additional increases in cybersecurity costs, and loss of consumer trust in the institution's ability to protect their money. Finally, economic downturns, worsening economic conditions and consumer confidence decrease the bank's lending and increase the loan defaults. We also wanted to touch on the Fed's decision to keep interest rates the same this week. They want to keep them around 4.25 to 4.5%. And despite encouragement from President Donald Trump and investor sentiment being so about the conditions of the market, Jerome Powell on the board said that the economy is healthy and it is unlikely that they will raise more and more rates in June or July as well.
Okay, so then taking a look at financials. So historically, JP Morgan has had very strong financials. And in this table, you can see that their financials are pretty strong. So taking a look at price to book, it is actually higher than the industry average. However, this is pretty normal because JP Morgan have historically traded for a premium. And then one thing to note is the PEG for past growth, or the PEG for future growth is higher than the PEG for past growth. This is primarily due to the fact they had very strong EPS growth in the past, and a PEG 1.22 is still pretty good for the industry. And taking a look at ROE and ROA, they've had pretty solid increases. Net interest margin does show they have good profitability. Slight decline over the past year, however, they're still above their two main competitors. And then lastly, looking at loans to deposits, they have good liquidity and risk management in sort of an uncertain economic environment.
Moving on to the debt that JP Morgan has, their capital structure is comprised of $344.75 billion in stockholders' equity and $3.66 trillion in liabilities. The typical cost of debt for the short-term borrowings in 2024 was 5.53, long-term debt was 5.49, and the average interest rate of all their liabilities in 2024 was 3.57. We also wanted to note that in 2024, the interest revenue generated by JP Morgan Chase from their assets was $193 billion, while the interest expense that they incurred was only $101 billion. So they're more than able to service the debt. Compared how much this debt is maturing soon, $7.7 billion in long-term debt is coming due in 2025, and this is majority comprised of senior and structured notes, as well as Federal Home Loan Bank advances and other subordinated debts that they have. Some more details on the debt of JP Morgan. They have an actively managed debt portfolio, and the goal of this team that manages the portfolio is to maintain a strong credit rating, which allows them to borrow capital at competitive rates. And the ultimate goal of this team is to maintain the financial stability of JP Morgan Chase.
For our first growth driver, we took a look at private credit expansion. JP Morgan has been exploring and investing in this space significantly for the past 4 years, as they just recently entered the sector in 2021, returning a net profit margin of about 35%. Private lending has shown about a 4% higher annual return compared to public lending, and allows for JP Morgan to have leverage in negotiations relative to their transactions, as they are taking a higher risk and have lower liquidity. For our private credit baseline, we just assume steady growth of compounded annual growth rate of 8.43 to 11%, and assume that our institutional investors would continue to show interest and continue to show steady interest in our private credit funds. And assuming our projected revenue increases to $103 billion and our earnings per share increases by $3.72. Our pessimistic outlook, we kind of highlighted a potential significant increase in defaults just due to interest rate volatility as well as inflation, which would put extreme number of pressure on our loan book. So our compound annual growth rate decreased a bit to 7.6% to about 9.5%. Projected revenue increasing to $96 billion, and earnings per share increases by $3.59. The second growth driver, optimistic, sorry. Our optimistic outlook, we assume strong demand from institutional investors, allocating large amounts of capital into our private credit funds, and then attracted by consistent returns as well as our brand recognition. Our compound annual growth rate about 9% to 11.5%, as well as projected revenue increases to $108 billion, and our earnings per share increases by $3.90. All right, now for our second growth opportunity, assets under management. Assets under management has grown by more than double from the years 2013 to 2023, from about 2.3 trillion to 5 trillion. We wanted to specifically highlight to you guys the steady growth in their mutual funds. We looked at their 1, 3, and 5-year mutual funds from the years 2023 to 2024, and saw a 33% in the 1-year mutual fund, a 12% return for their 3-year mutual fund, and a 6% return for their 5-year mutual fund. We thought this was significant as it points to successful client trust retention, as well as successful growth in the mutual funds, as well as the fee-based revenue that comes with our assets under management. Our net profit margin assumed at 25.5% over our mutual funds, ETFs, and managed accounts. Our mutual funds getting an average fee of 0.51% for JP Morgan, ETFs 0.32%, and for managed accounts about 0.5 to 0.6. Obviously, that fluctuates a little bit more depending on how much invested with the clients.
Yeah, so as Sean kind of touched on, our next growth opportunity that we're looking at is assets under management. As a baseline, JP Morgan is currently trying to generate more revenue in this field, and they do this by focusing on fee-based vehicles such as managed accounts, mutual funds, and ETFs. Some key assumptions that come along with this baseline is a 8.33 to 9% growth rate, and this would project their revenue to increase by $30.7 billion, and also our EPS to increase by 76 cents. So then looking at a pessimistic outlook for this growth opportunity, some factors that might attribute to this are a U.S. economic slowdown and market volatility, and also JPM's funds might fall in rankings performances, which would make them less attractive to investors. And then this would slow the AUM revenue growth. Some assumptions that come along with this are a growth rate between 6.8 and 8.4%, and the projected revenue would only increase by $26.5 billion, and the EPS will be by 51 cents. Then looking at an optimistic outlook, some factors that might attribute to this are strong global market performance, which what comes along with that is rebounding investor confidence and increasing capital allocations into these managed funds. And then some assumptions that come along with this are a growth rate between 8.43 and 9.25%, and a projected revenue increase by $32.4 billion and EPS by 81 cents.
Now we can dive into the valuation framework. Take a look below, you can see the baseline EPS breakdown under our core assumptions. We've sketched out years 2024 to 2029 based on our two drivers being AUM and private credit. We factored in inflation, interest rates, and tariffs into all these, and mainly in the start of the year 2025. Next for the valuation, we have our EPS estimates, and we feel that with consistent growth also integrated into this process, you can see in all three scenarios of baseline, optimistic, and pessimistic that there is growth in every scenario, even in a conservative scenario such as pessimistic. Here we talk about the price to earnings method as well as the price to book method, and finally coming to the combined target price. For our target price, the baseline number is $268.12. And we got that based on a weight of 35% for price to earnings and 65% for price to book. The reason we decided to side with price to book was because that's a main form of valuation that's used by banks all across the country. And as for PE, we just couldn't find as much then needed information based on Value Line, Morningstar, and any documents that we got. Now I'd like to talk about the portfolio fit of JP Morgan and how they fit in our already established position. As far as correlation goes, they hold a correlation of 0.70 with the Gordon Spellman fund, which is very aligned with fund performance overall. Just for a little summary, JP Morgan fits in the Gordon Spellman fund as a stable stock, only requiring some future rebalancing small investment stocks if need be. Our final recommendation is to hold the current shares.
And so for the summary, we would like to hold the current shares of JP Morgan Chase. Our target price of $268.12 would give the fund a return of 5.4%. We recommend this because of the solid growth opportunities that we identified in private credit and asset and wealth management, as well as lower evidence of risk in JP Morgan's debt management, as well as their strong position as an industry leader. That on top of the fact that it already has a relatively high current rating portfolio of 7.65%.
Thank you, and taking questions.
Can you go to the return section? I'm a little bit surprised when you show me the 215% return. How do you calculate that number?
That was the cumulative return for the past 5 years. Starting at whatever, like 98 to 254. No, that was just price return.
Sam?
Yeah.
Slow down. Good information, but now I'm gonna hit you with questions, just go ahead with that. What do you mean? We factor in tariffs and inflation, how are tariffs and inflation gonna affect JP Morgan?
So tariffs is gonna slow spending and just in general, consumer spending, so we feel that overall it doesn't directly affect the banking industry, but in general, imports and exports, and stuff like this. Sorry.
Well, I want to know that. Now I gotta follow
Go
up.
ahead.
How do people spend money, and where do they get it from? Or maybe two sources of cash, not now.
Cash, liquidity, and then this one, capital dimension.
Yeah, borrowing, and where do you borrow? So that would be one, okay, and then inflation, how does that? Why would the banks be concerned or not concerned about it?
Because lower or higher interest rates will then determine how the bank takes next steps.
Funds, we talked about the 1 year, 3 year, 5 year funds, were those returns on the funds, or they actually have a 1 year mutual fund, a 3 year mutual fund, 5 year mutual fund?
I think those were just separate mutual funds.
The mutual fund expert on.
I know exactly, but I'm curious to know, yeah, it's fine. What is 1 year, 5 year mutual fund, what does that mean? You guys are talking to state.
Yeah, I guess, how long did it take to mature and how long the clients of JP Morgan is giving them? Yeah.
No, that's your competitive returns against your peer groups, so. How does their mutual fund, if I manage a large cap growth mutual fund, and Tyler does, and Nick does, and. How would you compare to that? So if I'm more highly ranked, the likelihood over a 1 year period of 5 year return period, Morningstar, they look at that, Morningstar rankings, the higher you are on the rankings, the more likely theoretically your performance is, you're a better manager theoretically, you're more likely to attract assets. So that's what that is. Okay.
Mostly like people sitting on the couch chasing returns.
Yes. But there's, we can go into a totally different story, but I can go by 5 cents. Anyway.
What do you think that, they get what, 40% from investment banking?
Yeah, that's like the total
They do,
for commercial and investment bank.
okay. What do you think is gonna happen to investment banking?
I don't know, like interest rates.
Well, no, I'm just asking, like, like the next 12 months, you have a good economy for. Activities or.
For the next 12 months, I think it was obviously lower growth than we predicted for the future, so, you are the EPS. So.
Valuation.
I mean, it's lower, obviously the pessimistic, it drops a lot. And then in the future, kind of more when it pays off. Right now, for a to lower, so in the future, kind of that investment pays off, 75 million they invested.
Can I ask a question?
Yeah.
What's a CES? I've never seen that.
Oh,
Spacing.
yeah, I know.
I
tried to fix it.
I tried with nurse.
Yeah.
No, the table was a little too big,
Yeah.
Well, you have lots of white space, so.
Yeah.
That's
Adorable.
I knew exactly. Embarrassed, absolutely.
So the font is big.
It's fine to make this error here.
Yeah.
It makes it nice to read.
Next level.
We have a real question over here.
Yeah, banks are a different animal, all right, so
Yeah.
somebody opened the door on Jerome Powell's testimony today. In your presentation, so as I understood it, he did everything but spell the word stagflation. All right, so he built the components of it, but he wouldn't say the word, so what happens to our consumer credit portfolio under that type of a stress, where we're writing down the value of the portfolio while they have a harder time paying back the portfolio? How does that impact the earnings of JP Morgan?
Well, I mean, their credit costs were already rising, so you've seen that.
Yeah, I'm looking at the performance of the loans in particular. They've got an exposure to, well, I'm just looking at the consumer side. They got exposure to the consumer right now, who, according to the prediction that you're using in your forecast, is going to be under pressure at a time when we're looking at rising rates at the same time, which has a valuation problem. My point being, when you're analyzing a bank, it's a different than an industrial company. They have different components you have to pay attention to. Your stress test on that, you mentioned charge-offs and defaults growing. What are my loss given defaults? How is that going to impact the earnings? And then as you're also layering in higher interest rates, what's happening to my investment portfolio, the valuation of that portfolio, and how does that affect my retained earnings? Because that has to get marked to market. If you want to do extra, watch Silicon Valley Bank and their history, what happens in that situation. So when I'm saying, if you're going to tackle a bank, you have to understand how a bank is valued. And there's a lot more to that. Also, you brought up private credit. Who's buying their private credit? Where is that going?
For like what segment?
Yeah.
Commercial and investment banking.
Okay, and they're selling it to whom?
Institutional investors, I believe.
Okay, I was at a conference earlier this week.
Yeah.
Where every other presentation was on private credit for private wealth.
Okay, so like wealth management.
Yeah, well, yeah, so look out below. It's that's what the top of the market looks like.
Yeah, okay, but I mean, for like 2025, I factored in lower like growth rates for that. So it's not in the price targets, it's more accurately reflected compared to like the compound annual growth rates, which would be like the total. So for the next years, it will probably be lower and they won't generate as much revenue. And I mean, as you said, it could be not turn into anything in theory.
I try really hard not to predict markets.
Yeah.
There's some markers being laid down that are concerning. And if this is if this is a major component of our forward-looking revenues for JP Morgan, we might get to kind of take up this on.
I mean, I think it's relatively conservative. I think growth rates aren't too crazy in my opinion, but I think they have room for stable growth, even with maybe not private credit not turning out as well, essentially.
And also, I'm gonna go way back now. I'm bouncing all over that. I apologize. We have 3.6 trillion in liability.
Yeah, well, that includes their deposits.
Right, that's fine, but I presume we need to break that up. Deposits are
Roughly 70% of that is deposits.
Okay.
2.7 trillion.
that, I guess, when you're looking at a bank, that's not an insignificant separation.
Okay.
Okay, so that which belongs to the consumer or the depositor versus that which is owed to an outside entity.
Okay.
They're managed differently.
Yeah, I did that. There was a lot on the side, and I didn't know.
Yeah, no, fair.
I didn't
I
know
just-
exactly what to, I didn't know what you guys would like to see, so.
Yeah, and I just keep throwing rocks at you, and I apologize for that. I think this is, if you're going to do banks, understand how the bank works, okay, and make sure that we can kind of separate those two.
Gotcha.
Thanks.
Hi, everyone. My name's Emmy.
I'm Porter.
I'm Larkin.
I'm Porter Westford.
I'm Jake, and today we're gonna be telling you about our stock, Nucor. Just a quick outline of what we'll be talking about today. We'll do a business overview, talk about some of the risks associated with the stock, discuss our financials, the key growth drivers, which is steel mills and steel finished products, our valuation of the company, and then finally how it fits in the portfolio, and our recommendation of buying 100 shares at a target price of $172.63. So first off, what is Nucor? Nucor is a materials company based out of Charlotte, North Carolina, and they're continuously expanding. They're also the leading U.S. steel producer, producing roughly 1/4 of all the steel in the U.S. So they do this by using electric arc furnaces, which is a revolutionary technology able to convert scrap metal into steel. Some recent acquisitions they've acquired are the Rytec Corporation in 2024, which handles all their finished products, and then the David J. Joseph Company, which is responsible for their collection and recycling. This is important because they're able to convert the scrap metal into finished products and steel without going through a third party, any mining, and they allow themselves to be vertically integrated.
Now, real quick, here is a snapshot of our 52-week overview for you guys, so you can see the trends and where we're standing right now.
Bouncing off that, we're gonna look at how Nucor makes their money. So they drive the revenue through three primary business segments. Firstly being their steel mills, which is their core production. And this consists of 20+ EAF mills, which produce sheet, plate, bar, and other structural steel. Second is their downstream segment, which is their steel products, which produce value-added fabrication. This consists of 70+ fabrication plants, and they produce finished steel products like joist, post, steel rebar, and more. Lastly, their raw materials segment, which is their upstream segment, which is where they achieve their vertical integration. And this only accounts for a very small portion of their outside sales. However, it allows them to secure raw materials pricing. And through this, they undergo scrap brokerage. They have an electronic trading platform, as well as two reduced iron plants. Lastly, I want to share with you their primary markets and external shipments. First, they have their construction infrastructure, which accounts for about 50%, followed by heavy equipment transportation, and then traditional renewable energy, and lastly, auto and consumer durables. Looking at the 10-year revenue streams, we can see a general upward trend with notable outliers being in 2022 and 2021. And this was a result of post-COVID infrastructure spending and economic stimulus. We see these numbers drop roughly 20% in 2023, 24, and this is a result of normalization coming down from those all-time highs. Still notably 20% or roughly 50% higher than pre-COVID levels. Looking at Q1 of 2025, we had a net sales of about $7.3 billion. And looking at the mix of their different segments, we see their steel products consuming a larger share of their revenue streams year over year. And this is interesting and promising because these steel products offer higher margins, the finished steel products offer higher margins. And this indicates a move away from the potential volatility of mill pricing.
Next, to look at a couple of risks for Nucor in 2025, we have the first being global steel overcapacity. This is when the cheap imports from foreign competitors come over into the U.S. market and affect Nucor's pricing power. And then secondly, there is raw material volatility. Although we are vertically integrated, we still do rely on some suppliers of scrap steel and other raw materials. And that could make it hard if there was potential cost swings. Next, looking into tariffs. We decided to compare the 2018 tariffs effects on Nucor to the current policy. So in 2018, Nucor saw a very large boost within their profits from increased U.S. steel prices, as well as the decrease of foreign competitors in the U.S. market. After a little while, there was a fade in the profit surge that was happening, because there was a lot of loopholes found by foreign competitors, and they were entering the market through redirecting their supply through countries that were exempt from the tariff.
And then looking forward to 2025, the current policy, it is a much broader policy affecting all countries rather than just a select few. And also aims to help improve and mitigate the risk of the global overcapacity that we are seeing. Looking forward, this could prove as a competitive edge for domestic producers such as us as at Nucor, and gives us a more stable position within the market.
Great, so now we're gonna highlight some of the key financial ratios, to provide a little insight into Nucor's financial performance. So as you can see, their profitability ratios have dropped from 2022 as expected with the correction from the all-time highs seen. However, over a 10-year period, their ratios are significantly increasing overall. And looking at the trailing 12-month average, we see performance improving from 2024. And when we compare the trailing 12-month average to the industry, we see we are performing slightly better than the industry on average. And this indicates a strong financial position for Nucor and promising outlook relative to the industry. We're gonna now go on to the financials, focusing on debt and elaborating a little bit.
Overall, Nucor has a very strong yet flexible position financially, with a low debt to equity as well as a large amount of their liquidity. Looking at their debt structure, a very large amount is at fixed rates, with the recent $1 billion bond that was recently scheduled and paid for. Maturities are staggered throughout the upcoming years, so that kind of mitigates some of those near-term pressures that might come about. And then there is a revolving credit line that has a large money for any cushion in paying debt if needed. And then lastly, Nucor has a very strong focus within returning to their investors. So they have returned millions of dollars within the past year, as well as targeting a 40% or more return to their investors.
Now is a good time to transition and highlight what our reasoning and our calculations behind what we see for Nucor and its future sales growth. And this will also just back up behind where we're getting our growth rate numbers, as well as in valuing Nucor as a company. And what we ended up using is the Holt Winters model. It's a time series model that takes into account both seasonality and trends. And something about Nucor as a company is that they operate within a cyclical industry. Q2 and Q3 typically produce better sales than Q1 and Q4. So we took the last 50 quarters of Nucor sales data and then projected out the forecast for the for 2025 through 2029. And in addition to just why this model is so strong is because it takes it applies exponential smoothing. So the sales data towards, the more recent sales data is weighted more heavily.
Now to jump into the first growth opportunity we see here with Nucor is the steel mills. Currently, it represents 63% of the current revenue, and this would include the flat rolled steel and structural steel that Porter touched on earlier. The functional mills, all of them are currently operating at 80%, which is the sweet spot for these steel mills. It allows them to be profitable and efficient, but then also it allows them to be flexible in case of that oversupply that we may have talked about earlier. Now to hop into where we see growth opportunities here. With the reshoring and manufacturing has been a trend here lately. We see an increase, and along with that, active mill expansion. Nucor has been putting up a lot of mills, most recently the Kentucky and West Virginia mills. Now, both of those should be done in Q3 of 2025. Now, to look at the numbers here, as Carter mentioned with the Holt and Winter model, we took the 63% of our revenue and looked at that and broke it down over the percentage is. So over here, we're looking at a baseline of 7.69% through 2029. Along with that, we have our optimistic and pessimistic percentages up there as well. Optimistically, you know, what would allow that to happen is the Infrastructure Investment and Jobs Act that was passed in 2021. That $1.2 trillion bill comes up in 2026. So we believe that if there's a big push towards the end to increase that spending, that this would be a great optimistic view. Also just introduced in February was the Federal Infrastructure Banking Act. This is an act that will allow companies to get infrastructure loans a lot easier and directly through the government. Now, our second growth opportunity and the final one you're going to hear today is steel products. This is an emerging part of Nucor. Currently, the steel products, again, as Porter touched on, joist, decking, rebar fabrication, these are all high margin products for Nucor. This allows them to add value to the customers throughout the course of time. Now, the 25% increase here that you see is from the product shipped out in Q1 from that Brandenburg mill in Kentucky. These are all brand new products that we did not offer before. This is gonna increase what we can offer our customers as well. So on the growth opportunity side of this, we continue to see Nucor pursue M&A transactions, as we talked about earlier, within the steel products, and also we believe there will be a stronger demand with products moving forward in commercial and industrial spaces. Again, here, same as the last one, but we took 31% of our revenue to go about these numbers. So here you see the 7.67% through 2029 as our baseline. Along with that, our optimistic and pessimistic. We believe the optimistic will allow for acceleration, increase in spending, and what we have seen already in Q1 in 2025 is an increased backlog by 25%. Now, on the pessimistic side of that, we could possibly see some slower construction if that oversupply of steel is a problem. You know, inflation is also something to keep in the back of our minds moving forward.
Now, when it comes to the valuation side of things for Nucor, it's really important to highlight what we believe EPS will look like across all our different segments, as well as just the company as a whole. Nucor, the EPS is great because it takes into account what does it do for the shareholders, how will that profitability look? And what we did, we took the last 10 years of net profit margin, averaged that out to be around 9%, take that through 2029, as well as our shares outstanding, that has been on a decline of about 3%. So all things mentioned, this is how we got our EPS ratings across the board. And as you can see, it's trending upwards. So we do see Nucor as being a company that's going to provide increased value to shareholders. And then this is what it's going to look like across our three different outlooks. So for the optimistic and the pessimistic outlook, the thing we did to give kind of a lower bound and an upper bound for our valuation is we took 10% sales delta. So plus 10% for the optimistic, negative 10% for the pessimistic. And as you can see, using all things else equal, we still see a trend upwards across our EPS for all our outlooks. And then bringing it all together, we use the dividend discount model to finally value our stock. We get our intrinsic value from our free cash flow to the firm, free cash flow to the equity averaged out. That's how we get our target price for our baseline baseline outlook. As you can see, our target price comes in at $172.93. For the pessimistic, it'll come in at $148.12. And then the optimistic outlook comes in at $196.53. Right now, our current price as of yesterday sits in at $116.85. So a lot of value here amongst all our different outlooks. And then to give weight to every option, we decided to give 20% weight to both our optimistic and our pessimistic price, and then 50% to our baseline, to give us a final target price of $172.63. And then when you add in our dividend yield, we get a target return of 51.07%.
Now a little cherry on top here is Nucor is a dividend king. So over the last 50 years, they have paid out a dividend and increased it over that time. As you can see on the chart, over 50 years, we've definitely experienced some interesting economic times. They have still paid out on their dividends.
So looking at Nucor relative to the portfolio, if you take a look at the correlation matrix, you can see Nucor's correlation of the portfolio is about 0.58, which falls roughly in the middle, moving with the portfolio some of the time. When we compare it to the mega cap tech stocks that sort of dominate the portfolio, which hover around 0.65, this provides some much needed diversity and increases our material exposure. So based on the relative fit in the portfolio, our analysis and valuation, we determined the Spellman Fund should purchase 100 shares for a target price of $172.63, which would equate to a weight of about 3%.
Overall, we're recommending a buy today because we are market leaders, leading in both capitalization and sustainability. And we believe that we'll continue to do this with our key growth drivers of steel mills and steel products. Additionally, our model supports our claims of being severely undervalued right now. And we recommend buying 100 shares at a current price of $116.85. With a target price of $172.63 for a return of 51.07%. Thank you. Yeah.
It's us, there were analysts looking at a company and there's a couple of times like, we could offer this. This makes us competitive. So remember, we're analysts analyzing the company. Not necessarily a representative of Nucor. That's more of a, again, I don't know if the other groups did it, I just got it. Why do foreigners make steel so cheap? That always seems to be a concern of the US manufacturers. What's the difference between our process here that makes it so expensive compared to the cheap foreign steel that's coming in and gobble up market share?
I can kind of jump in on this. The research that I did, they are non-market economies, so they are kind of overproducing and they aren't readjusting what they're producing in the sense of what they need. So they're kind of just taking the excess that they have and needing to sell it because they have so much excess, because they're not adjusting to it. So they're just kind of taking that at the production price maybe and taking it over to the US to try and sell it, because obviously that could get sold if it's overpriced.
Another thing we probably add on there too is just labor costs in general. You know, here in the US, you have your unions, higher labor costs. Overseas, clearly not the case in most places, so.
The two new ones are going to West Virginia and Kentucky.
Yep.
Non-union states.
I believe so. I'm unsure.
I'm not sure. They always talk about the US, when you look at Honda and some of the automakers, it's South Carolina, Mississippi, Alabama, non-union states. I didn't know if that also included Kentucky. And then can you go to the whole?
Yeah, the whole winters model.
Okay, so we're taking. So this is
Yes,
historical.
this is
so there's
historical, last 50
forward.
quarters. Okay.
But weighted for the last few quarters when we've seen a shift in the product mix.
Yes, that's what the model for us. Yeah.
And should we be focused on the blue line?
So yes, so the blue line is what we ultimately took. This gray or the purple shaded area is representing more of like an 80% confidence interval. The gray representing 95%.
We talk about confidence intervals in the drive up.
Thank you.
How much does the blue whale
At a 90% confidence. I was texting her in that part. Kind of disregard that.
Well, but then you also have optimistic, pessimistic views.
Yeah.
Did you use the same model.
I did not, so we ended up doing just a 10% buffer of sales. You know, we technically could use that, but then it kind of makes our numbers look pretty bad. Because, you know, like this is a wide range. And sales is a huge impact as to how you value a company. If you see future sales, you know, dropping this much, it's not looking good, but.
I don't wanna, I'm done, go ahead.
What else is this model used for?
So this is a time series model. Based on my research, I found that, you know, Nucor, I'm like, okay, well, we're a cyclical company. What is the best you know, what's the strongest model in, you know, predicting something that includes those trends and the seasonality? And this is what I got. Quick little Google search. And I'm a stats minor, so I have had some experience in this kind of stuff.
I had a dog every time I hear that. That's one more. I know the answer already, but I'm asking anyway. Debt, scheduled and paid for. Main issue,
Did what? Sorry.
go back to you got a debt slide. So in that $1 billion bond, that was recently issued,
I misspoke. I should say it was like like they paid it, like in a sense, like they already, made, like, set off money. Yeah.
Okay.
Yes.
Okay, but I scheduled and paid for it, like, they, are we talking about something that was issued or something that was?
Yes,
Okay.
sorry, I misspoke.
The word is defeasance. Or if you have assets set aside to pay for the debt, you defease it.
Keep it word.
Needs that.
That's good as that.
You guys showed the revenue streams slide.
Yeah.
And you said there was a really big spike up because of COVID and all the kind of funding and stuff, infrastructure bills and whatnot. Were there any acquisitions that Nucor made over the past 4 or 5 years too that might have been part of that?
Well, they bought the Rytech Corporation, which,
Oh, you can say that.
yeah.
Did I say what year that they bought?
2024.
Well, so that's not really reflected.
It's not
in the-
super, yeah. I'm not sure if there was any other acquisitions.
There were no major acquisitions in this time. Since then, they planned to spend a lot in increasing their mills. So they have a lot of capital expenditure going into that and skip products, expansion for growth drivers. So we're kind of seeing maybe that reflected in their current spending now on projects.
So is increasing CapEx a good thing if revenue's going down?
Well, revenue's currently going up as of the latest quarter, but again, based on the cyclical nature of it, we still see overall improvements over a larger time scale. 2022 and 2021 was unprecedented, specifically in our industry. I mean, companies across the board saw numbers that, you know, were not anticipated and record highs in the stock market happened. So unless an event like that happens again, we see the revenue streams normalizing a little bit more.
What drives is it broader economic activity, is it infrastructure spending, is it private investment, what are the buyers of the products, who's driving this?
Yeah, so for Nucor, it's gonna be a lot of your government contracts is a big driver for them. That is, you know, they cater to the large scale construction companies. So, you know, those Amazons that are putting up the manufacturing facilities, the data centers that we're seeing, electric vehicles, things of that nature, those are their main customers and where they gear their focus towards.
Private investment.
Yeah, yeah.
Commercial construction, government.
So on this sheet, you have scrap metal price dependence, as a weakness. So is this a volatile price? Did you guys look into that at all? Does it have a big impact on revenue and earnings? And where is that like
Yeah.
sitting today?
that has an impact across the steel industry. However, one of the key strategic things that Nucor has an advantage in is their raw materials segment, where they're able to actually they have a whole segment dedicated to securing their own raw materials, as well as, trading different raw materials. So they do have a more stable access to raw materials. And then this is also countered by their backlog for their steel products segment, which is very large and increased 25% as of the last quarter.
See the dividend discount model, because I saw a free cash flow valuation, but I didn't see where we're dividend discount.
Oh, did I say dividend?
Yeah.
I meant discounted cash flow.
Discounted cash, okay.
Sorry.
Thanks for asking. I caught that too. I'm like, really? This is
No.
news to me.
Dividend model, but we didn't end up putting that.
Yeah.
Or even the-
Growth driver two, not forgot who presented that. Can you go through the slide? But I remember you saying that this was new as of 2024.
The steel products?
Yeah.
No, it's not new. The Brandenburg mill is new, which is their most recent mill that they built that produces solely steel products.
Okay.
Yeah.
But they've been doing.
They have been doing this in the past, but both these mills that they have built that are due to complete in Q3 are both for steel products.
Got it,
So-
sorry, I saw that and I saw your numbers and it's like, well, that's a
Yeah.
big number that's coming out.
Yeah.
Thank you.
No problem.
25% increase in available products. Is that like the number of SKUs, like the new I-beams plus this, plus that? Is that part of the acquisition that brought them into a new segment?
Yeah, so that 25% is the products that it's the beams and what you're able to offer, but also this is increased engineering. So these are products that were never offered, if you need to have a pre-made structure, we can now do that. So things like that was not offered in the past at all. So enhanced engineering allows us to just produce products that we have not had.
Don't compete with Warren Steel here because they're just
They're-
selling the share.
They're not able to vertically integrate like Nucor has.
Your correlation table. You had the correlation before relative to funds. Were the other stocks, are those the correlations to Nucor or those?
Those are correlations relative to the.
So what are the top stocks that Nucor is?
Well, according to the fund, they're so the top stocks they're correlated to are the other material stocks in the sector.
Did you run that analysis? Are there any like that we should be aware of?
We did, there was nothing that I noticed based on the weights, because materials overall weight was like around 1.5%, I believe. So there's nothing that I noted for my research, so
Thank you.
Yeah.
Have any of you guys bought the company personally?
Not personally, no.
I want to.
Yeah. Funds are a little tight for us. So, yeah.
But you're gonna pay the tariffs and more. Quick question, so the growth rates you guys had for growth revenue 1, 2, were they the same growth rates?
Yes.
Okay.
So in doing the statistical method or whatever, it's based on total sales. And we didn't have access to quarterly sales for each individual segment. So in doing so, we're gonna have the same growth rates, but technically our growth opportunities can grow at different rates, but the total sales is gonna stay the same and the overall valuation of the company is gonna stay the same.
This part where we can actually have the same systems.
You mentioned the end buyers, governments and large organizations, infrastructure projects. Do you feel like though that's economically sensitive? I mean, if we had a recession, would there be a significant pullback in revenues or these end users buying material?
I think in the short term, yeah, I mean, in a recession, everything slows down. But moving forward, I mean, these are things that have to get built if we want to keep enhancing what we can do here in the US, which I think is made a point that that's a critical thing moving forward for us. So yeah, I mean, in the short term, yes, but long term, I think that there will be a huge bounce back because of the updates that need to happen, and the buildings that need to be created.
In the finished products segment also caters more towards our commercial customers because we are able to tailor products for their needs. Versus the mills, which caters more towards our wholesale industrial.
In the pessimistic forecast, I know it's a 5-year look, so obviously recession will hopefully be short-term in nature, but I think you just used a 10% reduction. Do you feel like that's, if we had a recession in the next 5 years, unknown severity of it, but would that be enough to factor that in?
Want to say no. I would say, it doesn't take, like, the model, it doesn't take into consideration that it's, a recession-like event to happen. So, if we were to, as time goes on, if the current administration, if they feel a certain way, that could influence, I guess, more so whether or not we need to lower that, lower bound.
I'm just thinking of, in your target price, where it's at, you got a pretty lofty return expectation. In my mind, if we didn't see a lot of what's the worst case scenario, type of thing, what would that mean? And are we willing to accept that risk? There's always risk in investing. Potential probability of recession, what that could mean versus maybe what the base case is. But I think it would have been useful to demonstrate in some way what could a worst case or a decent probability and type of downside scenario.
So. Sitting in the table tonight, I'm sure that's what it's at. So it's 50 quarters, how many quarters? So 50 quarters, 4 was at 12 years. Yeah. Okay. So how, to your point, if you're looking back 12 years, how much of, we haven't had expensive slowdowns, but not really big recessions. I was just trying to figure out what we did in the past, if it's whole like looking, yeah. You have 10%. Here's a range. COVID.